The committee will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. This hearing is entitled Oversight of the Securities and Exchange Commission, Wall Street's Cop on the Block. I now recognize myself for 4 minutes to give an opening statement. Good morning. I want to welcome back Chairman Clayton and welcome Commissioners Jackson, Peirce, Roisman, and Lee to this important hearing on the SEC's role in U.S. capital markets. This is the first time since 2007 that all 5 commissioners of the Securities and Exchange Commission have testified before the Financial Services Committee. I believe it is important for the committee to hear testimony from each of the commissioners, including its chairman, because they each hold a vote on important regulatory and enforcement matters, and they each hold unique views that the committee should be aware of. This is especially important since the SEC is not fulfilling its mission as Wall Street's cop. Key rules like the Volcker Rule have been rolled back, while rules to implement other important reforms on issues like executive compensation, which Congress enacted back in 2010 as part of the Dodd-Frank Wall Street Reform and Consumer Protection Act, remain incomplete. Other regulations, such as the SEC's so-called regulation best interests, fail to protect retirement savers from unscrupulous financial advisors. It is also clear that our existing securities laws are not working, and there are loopholes in the laws that corporate insiders are taking advantage of. For example, executives are enriching themselves by buying or selling securities in their own companies during the 8K trading gap, which is a 4-day gap after a major corporate event before the company is required to notify the public and investors of that event. Corporate executives are also using stock buybacks to line their own pockets rather than giving their companies pay raises or investing in their companies. In addition, a court decision in Kokesh versus SEC limited the SEC's ability to recover wrongful gains from fraudsters like Bernie Madoff and return them to harmed investors. I believe that the SEC needs stronger tools to protect investors and punish bad actors. Members of this committee have introduced a number of bills to strengthen the Commission and our securities laws, and a number of these bills have passed this committee or the full House. Today, we will have the opportunity to hear directly from the commissioners on these important measures. In addition, I'm very concerned about Facebook's plan to create a digital currency, Libra, and digital wallet, Calibra. It appears that Facebook is working to create a new global financial system that is intended to rival the U.S. dollar. I and other Democrats on the committee have called for Facebook to halt their plans until regulators in Congress have an opportunity to examine these issues and take action. Today, I hope to hear what steps the SEC has taken to ensure that Libra is appropriately and rigorously regulated. I look forward to the testimony of our witnesses, and I now recognize the ranking member of the committee, the gentleman from North Carolina, Mr. McHenry, for 5 minutes for an opening statement. Thank
you, Madam Chair. Thank you for holding today's hearing. And I appreciate Chairman Clayton and the gang here joining you today. Interesting that the whole commission is here. The SEC has a three-part mission: to protect investors, maintain fair and orderly and efficient markets, and third, facilitate capital formation. Now, all 3 pillars of the SEC's mission are critical, but I believe the first 2 pillars, protecting investors and maintaining fair, orderly, and efficient markets, are encapsulated in that 3rd pillar, capital formation. For without capital formation, the other 2 could not exist. And that means that if you have no market to regulate, then people don't have the opportunity to invest. Without markets for retail investors to participate in, there would be no need for investor protection. So we need to help investors by focusing on policies that make our markets stronger, more attractive, and more competitive, not add regulatory costs and weaken them. We don't have to look any further than the impact of mandatory disclosure after mandatory disclosure on a company's compliance costs. Real costs, those are real costs borne by real investors, making it more onerous and expensive to be public companies. Companies heavily burdened by costs will choose to stay in the private markets, ultimately depriving retail investors of choices and opportunities in the public markets. To that end, I'm glad that the SEC chairman, under Chairman Clayton's leadership, is focused on long overdue reforms that focus on capital formation initiatives that benefit Main Street investors. The SEC's renewed commitment to revitalizing our public capital markets through increased capital formation could not come at a more appropriate time and more crucial time. When considering publicly traded companies in which to invest, American investors have roughly half the number of companies that they did compared to 20 years ago. To quote Chairman Clayton, the steady decline in the number of public companies in the U.S. is simply, quote, not good. It's a nice understatement. I share Chairman Clayton's concern. The decline of our public markets is a troubling trend for our country's competitiveness and for American investors, and for retirement savings as well. The solution to this crucial problem is to focus on policies that will make companies want to go public and preserve options for raising much-needed capital, all of which will lead to increased competitiveness and more investment opportunities for everyday investors to grow their savings. I'd like to commend the Commission for their efforts to improve capital formation for smaller companies, particularly by re-examining the exempt offering regulatory framework. Many of these exemptions were modified or created by the Jobs Act of 2012, a landmark bipartisan piece of legislation that has had a major impact on capital markets and small businesses. Now it's time for the SEC to revisit these private offering exemptions to streamline and improve the regulatory framework to better promote capital formation and grow investment opportunities. One exemption that warrants modernization is the crowdfunding exemption. My original crowdfunding bill, which was included in the Jobs Act, was only a few pages long, 11 pages in fact. I appreciate the SEC and their hardworking staff creating 685 pages worth of regulation around those 11 pages. The absurdity of this I point out a number of times since then, so you've given me at least the rhetorical value of talking about the burden of SEC regulation, making an exemption and a public law completely meaningless because of the impact and the cost. So I encourage the SEC to continue its efforts to expand investor access to all companies and to maintain its focus on reducing regulatory barriers that discourage companies from going or staying in our public markets. Stronger public markets translate to more economic growth and greater opportunity for everyday American investors to grow their savings and reach their goals of homeownership, retirement, or simply a better way of life. Now, in conclusion, we'll hear a lot of doom and gloom today. It is not all doom and gloom. The markets now appear healthier in the last 2 years. Investment opportunities are better now than they have been in recent years. I think there's a lot that is praiseworthy of the SEC's approach and how the market has responded to that. I look forward to your testimony and the questions today.
I now recognize the chair of the Subcommittee on Investor Protection, Entrepreneurship, and Capital Markets, Mrs. Maloney, for 1 minute.
Thank you, Madam Chair, for holding this important hearing and for inviting all 5 commissioners. The SEC has been active on issues such as cryptocurrency, market structure, and corporate governance. But by far, the most important action the SEC has taken was in June, when they finalized Regulation Best Interest, or Reg B1. This rule was intended to raise the standard of conduct for brokers and offer investment advice to retail investors. Unfortunately, I believe the rule was far too weak and did not raise the standard for brokers nearly enough. And to make it worse, the SEC also weakened the fiduciary standard for investment advisors, which was completely unnecessary and goes against the SEC's mission of protecting investors. So I'll be interested to hear from the Commission about why they chose this path, and I yield back. Thank you.
I want to welcome today's distinguished panel from the Securities and Exchange Commission. Commissioner Robert J. Jackson, Jr., who has served on the commission since January 2018. Commissioner Jackson came to the commission from New York University School of Law. Commissioner Hester M. Peirce, who has also served on the commission since January 2018. Prior to joining the commission, Commissioner Peirce had a post at the Mercatus Center at George Mason University. Commissioner Elad L. Roisman, who has served on the commission since September 2018, and who prior to joining the commission served as chief counsel to the U.S. Senate Committee on Banking, Housing, and Urban Affairs. Commissioner Allison Herren Lee, who has served on the commission since July 2019. Commissioner Lee has served for over a decade in various roles in the SEC, and most recently has written, lectured, and taught classes on financial regulation and corporate law internationally. And finally, Chairman J. Clayton, who has served on the commission since January 2017. Prior to joining the commission, Chairman Clayton was a partner at Sullivan & Cromwell and was a member of the firm's management committee. Welcome all. Before recognizing you for your testimony, I understand Chairman Clayton has a brief administrative statement. So without objection, Chairman Clayton, you are recognized.
Thank you, Chairwoman Waters and Ranking Member McHenry and members of the committee. Before my fellow commissioners and I each provide our opening statements, I'd like to give our usual disclaimer, which is that each of us will be providing our own views and remarks, which do not represent those of the SEC or our fellow commissioners. A few other administrative statements. I'd like to note that although all 5 of us are here before you this morning, this is not a meeting of the commission under the statute known as the Sunshine Act. And as a result, we plan to be mindful to avoid deliberating on business before the agency. We are also sensitive to the potential appearance of prejudgment. This means that although we may offer our views and share our concerns about general issues, we will avoid making a determination during this hearing about the course of action that the commission should or will take about any particular matter. As with our usual practice, we will keep an open mind and look forward to reviewing a fully developed record before making our determinations. Also, consistent with longstanding commission practices, we would not expect to comment on pending litigation or enforcement actions. Thank you, Chairwoman Waters.
Thank you, Chairman Clayton. For purposes of testimony, each of you will have 5 minutes to summarize your testimony. When you have 1 minute remaining, a yellow light will appear. At that time, I would ask you to wrap up your testimony so we can be respectful of both the witnesses and the committee members' time. Commissioner Jackson, you are now recognized for 5 minutes to present your oral testimony.
Well, thank you, Chairwoman Waters, Ranking Member McHenry, and members of the committee. Thank you very much for the opportunity to join you today. It is my great honor to be joining my colleagues to testify before you on our task at the Securities and Exchange Commission, protecting ordinary American investors. I want to begin by expressing my gratitude for the special privilege of working with the tremendous SEC staff that we work with every day. I have learned a great deal from them, and everything we do and we'll discuss today is possible only because of their tremendous public service. Now, Chairwoman Waters, before I joined the SEC, my work in government as a teacher and as a researcher focused on the gaps in our securities laws that allow corporate insiders to spend shareholder money to advance their own interests rather than those of investors. Because this committee is right now considering legislation that could address some of those gaps, I want to identify 3 areas where, in my view, doing so would be especially critical for investors. First, our disclosure rules have not kept up with the pace of today's markets. Specifically, SEC rules give public companies 4 days before they must notify the market about market-moving business developments on what is known as our Form 8K. A study I released before joining the commission provided evidence that corporate insiders often trade during this gap between key corporate events and when our rules require that event to be revealed to the public. I am grateful that this committee has taken up bipartisan legislation that would close that gap and give investors the level playing field they so deeply deserve. Second, our rules incentivize corporate insiders to pursue stock buybacks that maximize executive pay but make no sense for ordinary investors. In a speech last year, I provided evidence that executives engage in significant sales of their company's stock after announcing a buyback. And I expanded upon that work in a letter to Senator Van Hollen this spring, showing that when insiders sell into a stock buyback, their company performs worse in the weeks after the buyback occurs. SEC rules should not incentivize buybacks that allow insiders to cash out but don't make long-run sense for ordinary buy-and-hold American investors. And finally, we should consider giving investors much more transparency into how public companies spend their money on politics. A significant amount of corporate political spending is not disclosed under the law we have today, since public companies can and do give investor money to intermediaries that do not disclose their donors. Indeed, a study I published in 2013 showed that just 8 intermediaries spent more than $1.5 billion of investor money on politics over just a short period. Under the law we have right now, ordinary American investors have no way to know whether the companies they own were a source of that money. Now, that would be less worrying if executives' interest in political spending were aligned with those of shareholders. But when it comes to politics, insiders' interests may diverge from those of investors. Political spending has consequences that goes beyond the company's performance, like advancing insiders' preferred political views, and executives' decisions may be influenced by those preferences. Now, the standard securities law solution to conflicts like this is disclosure. That's why SEC rules mandate clear disclosure of executive pay. That's why our rules also require companies to give investors detailed information about transactions between insiders and the company. And that's why the case for requiring disclosure of corporate spending on politics is so strong. Now, before joining the commission, I led a bipartisan group of scholars who petitioned the SEC to develop rules requiring disclosure of corporate political spending. Since then, more than 1.2 million Americans have written to the commission urging us to adopt those rules. And a bipartisan group of former SEC officials, including 2 former chairmen, have called our proposal a slam dunk. But because Congress has used the appropriations process to block the commission from developing rules in this area, too many American investors today remain in the dark about how public companies spend their money on politics. I believe that a critical part of the SEC's mission is to make sure that ordinary investors stand on a level playing field in today's markets. Gaps in our securities laws that allow insiders to trade before key information comes to light, stock buybacks that maximize executive pay but not buy and hold investor performance, and rules that allow insiders to spend investor money on politics in secret undermine the trust that ordinary Americans have in our financial system. I am delighted that this committee is considering how best to close those gaps. And of course, on all these matters, I remain open to the views of my exceptional colleagues here on the commission, and it is my great privilege to be a part of their work. Thank you again for the opportunity to appear before you today. I'd be delighted to answer any questions you might have.
Thank you, Commissioner Jackson. Commissioner Peirce, you are now recognized for 5 minutes to present your oral testimony.
Chairwoman Waters, Ranking Member McHenry, and members of the committee, it's an honor to be here today, and it's a particular pleasure to be here with my colleagues. We all share a common passion for the capital markets because we believe they have the power to unleash talent all across the country, and that's good for all of us. Under Chairman Clayton's leadership and with the help of our hardworking staff, we are applying this shared passion for the potential of the capital markets to change people's lives, to think through to collaborate and think through a wide range of issues related to protecting investors, facilitating capital formation, and protecting the integrity of our markets. I'd like to talk to you today about 3 principles that I apply when I do my job. The first is that investor protection means more than just protecting investors from fraud. It also means protecting their opportunities. The second is that while enforcement is an important part of our mission, regulation is the key part of what we do. It's our first step, not our last step. And third, we as regulators don't and we can't know everything. Investor protection is, of course, on our minds in everything that we do. One of the key purposes of the securities laws is to make sure that investors get the material information they need to make decisions about where to invest their hard-earned money, and they often do that with the help of a financial professional. Our Office of Investor Education and Advocacy helps investors navigate the complex financial markets, and through our compliance and enforcement programs, we make sure that institutions and individuals involved in our markets are doing their roles in a way that benefits investors and the markets. Our role is not to make decisions for investors. Investors, if provided with adequate, clear, and truthful information, are best suited to make choices about which investment products serve their own particular needs and goals. When we place unnecessary limits on investors' opportunity to buy products, we risk substituting our own judgment for that of the investors. Overriding investor preferences about how to spend their hard-earned money is not investor protection. This principle has informed my views on digital assets, retail access to private markets, and retail access to different types of investment financial professionals and investment products. Regulatory flexibility and the attendant ability to respond to investor demand is key to making sure that investors get what they want and need. My second principle is that the SEC is a regulatory agency, not an enforcement agency. Of course, we bring enforcement cases when people flout our rules, as we should, but enforcement is a poor way to announce policy. We need to be clear in writing our rules, and we need to make sure that we provide the guidance that firms and individuals need as necessary. We understand that our rule book is complicated, and we work with well-intentioned firms and individuals to help them comply with our rules. My third principle is regulatory humility. As I said, we can't and don't know everything. We draw on the talents and expertise of our staff, and we also look outside the building. We have a number of advisory committees that we rely on to advise us on a number of issues. We also hold roundtables with industry and investor representation to talk about pressing issues of the day, and we also have investor town halls where we go out and we meet with investors. We also look to our fellow regulators for their expertise. I, for example, am working on the security-based swap regime, trying to get that up and running, and we've been working very closely with the Commodity Futures Trading Commission in making that happen. We're also looking at our rules all the time to see what needs to change. Sometimes we need to write a rule to to codify exemptive orders that have been issued for a long time, or maybe the staff has been doing something by no action letter, and we're going to adopt a rule to put a more permanent framework in place. I think regulatory humility comes into play in all of these things. We always need to be asking if we're doing things right. I think one area where I'd like us to take a second look, to take a step back and look, is the consolidated audit trail. I just want to ask whether it's right for a government regulator to collect all of the purchase and sale decisions of every retail investor in the United States, regardless of whether they're accused of any wrongdoing. So with that, I just want to thank you for the chance to be here today. I look forward to your thoughts on what we can be doing better, and look forward to your questions as well. Thank you.
Thank you, Commissioner Peirce. Commissioner Roisman, you are now recognized for 5 minutes to present your oral testimony.
Thank you. Chairwoman Waters, Ranking Member McHenry, and members of the committee, thank you for inviting me to testify today. I'm honored to appear before you with my fellow commissioners. This month marked my one-year anniversary as a commissioner, so I'll use this opportunity to share some of my reflections on the past year. I've often said that the U.S. capital markets are the envy of the world, and the importance of the SEC's role cannot be overstated. It's truly a privilege to go to work every day with the dedicated and hard-working staff of the Commission. They embody and deliver on the SEC's tripartite mission to protect investors, maintain fair, orderly, and efficient markets, and facilitate capital formation. Protecting investors is front of mind for me as I dedicate time each day to reviewing potential enforcement actions as well as potential rules. Our written testimony provides more detail, but I am consistently impressed by the matters the staff presents to the Commission with protecting investors in mind. I think it's important to note that all of our divisions and offices, and not just enforcement, are working to protect investors. For example, the SEC's Office of Compliance, Inspections, and Examinations has been instrumental in conducting exams in high-risk areas across the industries we regulate. Not only have I seen them spot and refer potential securities law violations to our enforcement staff, I've seen them help us get ahead of such violations by directly engaging with the SEC registrants and publishing materials that all compliance professionals can use to do their jobs more effectively. The Office of Investor Education and Advocacy has also played an important role in protecting investors through their bulletins, videos, and outreach events. I have been particularly impressed at how all of the Commission's divisions and offices have worked together to address an area that I care deeply about: elder investors. As one example, next week, staff from across the agency will host a roundtable on elder investor fraud with experts from the private and public sector. I look forward to joining the SEC staff at this event and engaging with everyone on how we can better identify, prevent, and combat fraud targeting elder investors. With regard to maintaining fair, orderly, and efficient markets, I take this part of our mission very seriously. Market integrity is a priority for me, not only with respect to our equities markets, but for our fixed income and treasuries markets as well. In this area, I greatly appreciate the work that our Division of Trading and Markets has done to closely assess how these markets are working, whether they work as intended, and where there is room for improvement. Outside the secondary markets, the Division of Investment Management has also done impressive work to streamline and improve regulation of important segments of the asset management industry through which U.S. retail investors are increasingly accessing securities markets. With regard to the final tenet of our mission, encouraging and facilitating the entrance of companies to our capital markets, especially small businesses, is incredibly important. I appreciate that for the past year, the Division of Corporation Finance has been working hard, hosting roundtables, soliciting comments from the public, recommending rules to facilitate issuers' ability to conduct registered public offerings, lower their cost of capital, and provide Main Street investors with more investment opportunities. I believe their participation is a necessary component of successful capital markets and one that has been a hallmark of our markets since their inception. It's also a reason that countless Americans have been able to save for retirement, pay for school, and deal with unexpected financial inflection points in their lives. I'd also be remiss in not mentioning my interest and appreciation for this Commission's focus on the proxy process, which I believe is a fundamental aspect of our capital markets. In closing, I'm grateful for the opportunity to share with you some highlights from my first year as an SEC Commissioner. Your oversight of our agency helps us operate at our best, and I look forward to answering any questions you may have for me. Thank you.
Thank you, Commissioner Roisman. Commissioner Lee, you are now recognized to present your oral testimony.
Thank you. Chair Waters, Ranking Member McHenry, and members of the committee, thank you for the opportunity to testify before you today. I'm roughly 2 months into my term as a commissioner at this point, and it has been a privilege to work with my distinguished colleagues here and with the dedicated staff of the SEC. Having served at the SEC for over 13 years prior to my appointment, I have experienced firsthand and developed a deep appreciation and respect for the commitment and dedication of the staff to the mission of the agency. I can say that from my vantage point as a commissioner, that respect has only increased as I have met and worked with dozens of dedicated staffers in each of the divisions, people who have developed extensive expertise through years of day-to-day hands-on work with investors and other market participants. I'm inspired by their commitment, as well as that of my colleagues here today, and I'm more determined than ever to do all that I can to help the agency do its part to protect and strengthen the economic well-being of Americans and American businesses. Although we deal with a large number of often highly complex issues and rules, from market structure to cybersecurity, they should all be viewed and analyzed through this lens. Whether and how they will promote and strengthen the economic well-being of everyday Americans, saving to buy a home, to send their children to college, and to eventually retire, and American businesses, which need a fair marketplace with clear and manageable rules to facilitate growth. This committee has identified a number of critical issues for discussion today: the increase in the amount of capital raised in private versus public markets, the importance of ensuring that public companies disclose in the most effective manner possible the information that investors need to make informed decisions in an era where business models and the relevant risks to those models are changing, the SEC's enforcement program and its ability to get money out of the pockets of fraudsters and back into the hands of their victims, digital assets and cryptocurrencies, and the role of financial intermediaries in our markets. With all of these issues, it is important for the SEC to be held accountable by the investing public, by those we regulate, and of course by this committee and by Congress. Whether we're making changes to the staff's longstanding review process for shareholder proposals, assessing the fiduciary duties of investment advisors with respect to proxy voting, or considering how best to modernize and strengthen public company disclosures, we must be fair and transparent about the policy choices we make and the data and information on which we rely in making those choices. I thank the committee for its interest in and oversight of these important issues, and I stand ready to answer your questions and listen carefully to your thoughts and concerns. Thank you.
Thank you very much, Commissioner Lee. Chairman Clayton, you are now recognized to present your oral testimony.
Thank you, Chairwoman. And I want to echo the thoughts of my colleagues on the opportunity we have to testify today, and also just note that their testimony demonstrates the wide range of issues that the Commission deals with every day. I want to thank this committee for your support of the Commission, and in particular the dedicated women and men who are our most important asset. The funding that you provided to us for fiscal year 19 allowed us to lift our hiring freeze and make new hires in critical areas, including enforcement and examinations, market oversight, cybersecurity, and small business capital formation. I'm pleased to report that we have filled approximately 100 new positions with high-quality individuals that I expect will serve American investors very well. The fiscal 19 funding that you provided us also allowed us to continue to make significant investments to and upgrade and otherwise improve our IT infrastructure, cybersecurity, and risk management. We've made progress in these critical areas. However, our information technology needs and the related risks are ever-changing, and let there be no doubt, substantial work remains. Turning to our mission, for me, the interests of our long-term Main Street investors are front of mind. I believe our 4,300 colleagues share this perspective. I want to highlight just a few examples of the recent work of the Commission in this regard. Starting with our Division of Enforcement, I note our Teachers and Military Service Members initiatives, which focus additional enforcement and investor education resources on behalf of teachers, veterans, and active duty military personnel. Unfortunately, these hardworking Americans are too often targeted and fall victim to fraud, shady, and self-serving practices and other misconduct. My message is simple. If you're ripping off teachers, service members, or veterans, we want to catch you, we want to punish you, and we want to get them their money back. Returning funds to harmed investors continues to be a priority for me and the agency. I previously testified about challenges, including legal impediments we face in obtaining funds from bad actors in cases with long-running, well-concealed frauds, such as Ponzi schemes. I want to recognize and thank this committee for its bipartisan work to address these challenges. Enhancing Main Street investor protection while preserving and improving access to investment opportunities also has been a priority. In June, the Commission adopted a long-overdue package of rules and interpretations to require candor and impose other responsibilities on broker-dealers and investment advisors and their dealings with our Main Street investors. As a result, for the first time, regardless of whether an investor chooses a broker-dealer or an investment advisor, the investor will be entitled to a recommendation that is in the investor's best interest and does not place the interests of the firm or the financial professional ahead of the investors. This strong rulemaking package was informed by the Commission's expertise and decades of experience regulating, inspecting, and bringing enforcement actions in this space. It also benefited from unprecedented direct shareholder engagement, including 7 town hall-style investor roundtables held across the country. We are already seeing the benefits of this work. We are also focused on the implications for Main Street investors of the substantial changes that have taken place in our markets over the past 2 decades. For example, 25 years ago, the public markets dominated the private markets in virtually every measure. Today, the private markets outpace the public markets in many measures. However, in our private markets, Main Street investors, 1, typically do not have the same access to investments as sophisticated professional investors, and 2, where they have access, they typically do not have the same alignment of interest with sophisticated professionals as they do in our public markets. In response, we continue to explore initiatives to increase the attractiveness of our public capital markets as places for companies to raise capital. At the same time, We are also exploring whether we can increase the type and quality of opportunities for Main Street investors in our private markets while maintaining appropriate investor protections, including aligning the interests of Main Street investors with professional investors. In closing, I want to refer you to our written testimony, which details a number of the risks that we are monitoring along with our fellow U.S. regulators and regulators around the globe. Thank you, and I look forward to your questions.
Thank you very much, Chairman Clayton. I'm going to deal with two issues here as I recognize myself for 5 minutes for questions. First, I want to deal with insider trading. I'm going to you, Commissioner Jackson. Current loopholes in the law allow corporate insiders to enrich themselves at the expense of their shareholders. For example, there's evidence that insiders are misusing SEC Rule 10b-5(1) to engage in illegal insider trading by changing their trading plans. My bill, the Promoting Corporate Standards for Corporate Insiders Act, would require the SEC to study this apparent misuse and amend its rules accordingly. This bill passed the House on a broad bipartisan basis. Can you please discuss why it's important for retail investors and market integrity for loopholes to be fixed? Do you agree that the Promoting Transparent Standards for Corporate Insiders Act is a common sense fix to the apparent loophole in Rule 10b-5-1? Insider trading has been a problem historically. What do you think?
Well, thank you, Chairwoman Waters. First of all, I want to thank you and this committee for focusing on this important issue. You know, Rule 10b-5(1) was adopted some time ago, and it's always a good practice for us to dig back into our rules and see if they're serving their intended purpose. That rule was intended to allow insiders to make trading decisions long in advance, not based on any particular timing. And there is some academic evidence to the degree that they're taking advantage of investors. So I think studying this subject makes a great deal of sense. And again, without commenting on any particular legislation, I'm glad this committee is focused on this issue.
Thank you very much. And now, but Chairman Clayton, as we have discussed, I'm extremely concerned about Facebook's planned cryptocurrency, Libra, and digital wallet, Calibra, and their potential impacts on investors, consumers, and the American financial system. Treasury Secretary Mnuchin, Federal Reserve Chairman Powell, and even President Trump have raised similar concerns. Just this month, regulators from France and Germany both agreed to block Libra from their countries. In a joint statement, the two governments stated that, quote, no private company can claim monetary power which is inherent to the sovereignty of nations, unquote. Can you please talk about the systemic risk and risk to investors that Libra, as currently described, would pose?
Thank you, Chairwoman. I'm not going to comment on any specific crypto asset, other than I will note that the attention that Libra has raised, I think, is a good thing. We're having these discussions, and regulators around the world are focused on it. But I do think that crypto assets, while they have benefits, including eliminating frictions and the like, can present a great deal of risk, particularly in cases where in form they are the same as securities or the same as currencies or they're the same as payment systems, but they're not regulated in the same way. We have developed what I would say is an ecosystem of financial regulation over the years, securities, commodities, currencies, payment systems, that deals with a great deal of risk to investors and risk to our markets more generally. To the extent a crypto asset would be used to evade those regulations, I have a real problem with it.
What are you doing now to take a look at Libra and Calibra? Have you set up a committee, a commission, an advisory group? Are you looking at it so that you can understand what those risks are?
Yes, we have a group at the commission that is focused on digital assets, both the potential they have to add efficiency, but also the risks they face. And look, we saw this in the quote-unquote ICO space. You know, $4 billion, or pick your number, raised, most of it gone, not complying with our rules. You know, I think we had a great effort from our Division of Corporation Finance, as well as our enforcement division, to say, hey, if you're selling securities, you got to follow our rules. And we're going to do the same thing across all digital assets that touch in the security
So you
space.
do have a committee of some sort that's taking a look at what is happening with the development of Libra.
Yes. Well, yes. All digital assets that come to our attention. Also say at FSOC, we're looking at digital assets in a more
What about the
holistic
entire blockchain phenomenon? What do you know about that? What work has been done on that? Is there an opportunity to perhaps brief the legislators on the work that you may be doing, both looking at Libra and looking at all of blockchain?
Be very happy to do that. I would be very happy to do that. I'd be very happy to do that with my colleagues at the Commission. I can't speak for my other federal financial regulators, but jointly with them, happy to do it.
Thank you very much. I now yield to the gentleman from North Carolina, the ranking member, Mr. McHenry.
Well, why don't we start there? Mr. Chairman Clayton, why don't we start with digital currencies? That's where it's going to end. So, Chairwoman and I have a similar thought process on raising the question. Based off your current analysis of the Libra project, which is just an idea at this point, a white paper, Chairman Clayton, do you believe that Libra is a security?
I'm not prepared to make a decision like that here. We have to see how different assets function to decide whether they would be a security, a commodity, a currency, or not. But if what you're doing is using a digital asset to raise capital for a project with the idea that you're going to get a return as a result of investing in that project, sounds like a security.
Okay, so, but let's acknowledge there's a larger ecosystem to raise money globally outside the U.S. jurisdiction, right?
Yes.
So we need to have appropriate regulation, but too onerous regulation just drives off the innovation from the United States and the upside potential for investors. Is that correct?
That is correct.
I know, Commissioner Peirce, you've done a significant amount of work in this space. But for cryptocurrencies, we see that Blockstack had their Reg A offering approved. Now, walking through that process, Commissioner Peirce, do you believe we have a pretty solid ecosystem for cryptocurrencies to exist in the United States and to raise capital in a regulated environment?
I think we still have work to do to make sure that people can develop digital assets in the U.S. in compliance with our rules. I would like to see us be a little bit more forward-thinking in ways that we might accommodate unique aspects of digital assets. For example, digital assets that are utility tokens. I don't know that the securities law framework that we have right now is the appropriate framework for them, and so I'd like to see us think about creating some kind of a safe harbor. Again, the idea is to allow...
Is there current law for the SEC to write regs around that?
I think we have authority that would enable us to work on something like that. I still am giving it thought, but I think we do have authority that could allow us to do that.
Chairman Clayton, how would you respond?
We have a lot of discussions about this. I agree with Commissioner Peirce that, look, to the extent this technology facilitates capital raising, consistent with our investor protection, and I think it's been pretty good in the private space. I mean, I'd like to have more access for individual investors. If we can use it to have more access in a protected way, I'm good with it. And I'm good with exploring ways to do that. But what we saw in the ICO space was something that, I don't think anybody thinks that was a success.
Okay, so let's move to crowdfunding. I raised this in my opening statement. 11 pages of legislative text that we passed in a bipartisan way, not without dissenting votes, but we had fewer than 15 dissenting votes on the House floor, and bipartisan nature. So investment crowdfunding, regulation crowdfunding, such as the limits on individual investment limits, the total amount raised, and the overall goal of this. Is the SEC willing to relook at those 685 pages of extensive, onerous regulations?
Yes, and I think we should. I think if you look at the market for small business capital formation, crowdfunding shows that you can get started. You can get up to, and I'm going to talk about pretty large valuations, but they're small in the range of businesses. You can get up to $1 million company going with reg crowdfunding and some of our other exemptions. It's really hard to grow a business from say, a $1 million business to a $50 million business, because you're talking about individual investors and crowdfunding at $1 million. You're talking about professional investors at 50. There's kind of a big gap there. Things that we can do to facilitate capital formation in that gap so our small businesses can become larger, I think that's an area we should focus on.
Okay, so to go much more broadly here, Chairman Clayton, we have fewer public listings than we did 20 years ago. That means mom and pop retail investors don't have the same potential that they did 20 years ago for their long-term savings. Is this a concern to you? And if so, what are you doing to address it?
It's a very big concern of mine. The great thing about our public markets is mom and pop investors invest right alongside with the same deal as professional investors. I like seeing capital raising in that environment. This group passed the Jobs Act. I think the Jobs Act helped encourage companies to go back into the capital markets. One of the things we've been doing is looking at those Jobs Act provisions and seeing if we can extend them.
Thank you.
The gentlewoman from New York, Mrs. Maloney, is also the chair for the Subcommittee on Investor Protection, Entrepreneurship, and Capital Markets. Is
Thank you,
recognized
Madam
for 5
Chair.
minutes.
Chairman Clayton, as you know, I've long been an advocate for using structured data in financial reporting, and I think it helps both investors and public companies, and it actually makes it easier for companies to raise capital. Last year, the SEC adopted a rule requiring public companies to report certain financial and risk formation information in so-called inline XBRL format. And I applaud the SEC for taking this step. Today, I'm going to be introducing a bill with Ranking Member McHenry called the Financial Transparency Act, which would direct financial regulators, including the SEC, to require that companies make their filings in structured data format. So I'd like to ask you, Chairman Clayton, in light of the SEC's work in this area, do you think that this bill is a step in the right direction and complements the efforts, the good efforts of the SEC in this area?
So, and the question of making data more usable, accessible to various market participants, yes, and in particular doing it in a way that, depending on whether you're very sophisticated or a retail investor, you can have access to that data. Very supportive of that. I will note that how data gets scraped and used has changed over time, and I would just encourage everyone in this space to be forward-looking and allow flexibility in achieving the objectives of making data more accessible.
Thank you.
Supportive.
Commissioner Jackson, I want to ask you about the Commission's recent interpretation of the Advisors Act that was adopted along with Regulation Best Interest. But first, I want to remind my colleagues why we passed so many investor protections in Dodd-Frank in the first place. We did it because 8 million people lost their jobs, 6 million people lost their home, and the crisis, the financial crisis, destroyed over $15 trillion in wealth for middle-class Americans, their pensions, their savings, a devastating effect on our economy and our country. So given all of this, the very last thing the SEC should be doing is weakening rules that would protect investors against these kinds of losses. But unfortunately, that's exactly what the Commission's interpretation of the Advisors Act would do. It would weaken the longstanding fiduciary standard for investment advisors and increase risks for retail investors. So Commissioner Jackson, I know that you voted against this. You opposed the final interpretation of the Advisors Act. So can you explain why you think the interpretation weakens existing law and poses more risks to investors and our economy?
Thank you, Congresswoman. Yes, I was unable to join my colleagues in voting for those rules. I dissented from the entire package, and the reason is very straightforward. My own view is that the law in the United States should be clear, that when there's a conflict between an ordinary American investor and their financial advisor, the investor comes first. I think we should be unambiguous about that in all that we do in our work. And the rules that we adopted, including the interpretation you just mentioned, had instead a muddled standard that has to do with the balance between the various interests. My own view is that we should be clear with American investors that they come first. And when I dissented, my office released data showing that Wall Street has been saying in brochures to American investors for years that they would come first. So my own view is that not only was it a mistake for us not to make that clear in the interpretation, but also that we upset the prevailing expectations ordinary investors have when they entrust other people with their family's financial future.
So how do we correct this?
Well, so a number of the things that I mentioned in my statement would address this problem. One of them would be to use the authority Congress gave us in Dodd-Frank. There's express authority under Section 913G that would allow us to set a uniform and strong standard with respect to investment advice in this country. I continue to think that that's an approach that we should give more consideration to, and I look forward to seeing how the package we've adopted plays out in the marketplace and whether we actually need to be much stronger in this area.
Well, thank you very much, and possibly the SEC should revisit this and come back with the standard that President Obama supported and worked so hard for. I yield back.
Thank you. The gentleman from Oklahoma, Mr. Lucas, is recognized for 5 minutes.
Thank you, Madam Chair. Firstly, Chairman Clayton, I'd like to commend you and the commissioners for the tremendous progress the SEC has made in completing the derivatives rules required by Dodd-Frank. And now, as a final step, SEC will need to address the cross-border application of these rules. I guess my first question would be along the lines of, in a transaction that occurs between parties fully outside of the United States, a U.S.-based employee will often help arrange, negotiate, and execute the transactions. And these are referred to as A&E transactions. I've long been an advocate of harmonization between the SEC and the CFTC. As such, I would like to urge the SEC to harmonize with CFTC on how A&E transactions are treated. In this vein, I hope the SEC recognizes the need to safeguard against any incentive for firms to move jobs abroad. So, Chairman Clayton and Commissioner Peirce, could you speak to the issue of harmonization with the cross-border rule? Either or.
Well, let me
I'd
say
love to
this.
hear from you both.
I want to thank Commissioner Peirce for taking the lead on these rules. She's done a terrific job, including working with our colleagues at the CFTC. And you raise one of the difficult issues in making. You have a transaction between two parties outside the United States, but let's say it is arranged in the U.S. because, that's where the expertise for this transaction is. And in fact, it may involve what we would consider an asset or a security that's important to the U.S., like U.S. interest rates or, in our case, a U.S. security. At what point do we say that transaction that's the risk is offshore on the parties is something that we still have an interest in regulating because it happens here in the United States? And Commissioner Peirce and I are working with our colleagues and our colleagues here on trying to draw that line in a way that makes sense, not only for regulating the parties, but also dealing with systemic risk.
And I would just add that we have been working very closely with the CFTC on this issue as well as other issues in the Title VII space. And I think we can draw from their experience what's happened in their markets because obviously their regime has been up and running, whereas ours has not. So we're talking with them, we're learning from them, and we are trying to achieve harmonization as well as allow substituted compliance in other areas where that's appropriate.
Because clearly we live in a world where both talent and resources are easily moved around the globe. Again, I want to express my appreciation for the work in supporting more efficient markets and serving U.S. investors. So back again to you, Chairman. We've spoken several times on your active engagement with the CFTC. Could you elaborate on any other areas in particular where you hope to see further coordination?
Look, I think an area where there is, I'd say, room for improvement, and we're doing well, is on inspections. As we both inspect some of the same firms, and on further harmonization, including on reporting of information. It doesn't make a lot of sense to require people to report two different sets that essentially have the same information. Those kinds of things we can improve.
Thank you, Chairman. And amazingly enough, Madam Chair, I will yield back the balance of my time.
Thank you. The gentleman from California, Mr. Sherman, is recognized for 5 minutes.
Mr. Jackson, thank you for your presentation, as it is indeed outrageous that shareholder money is used to pursue political objectives that may not only contradict what the shareholder wants, but is done in total secrecy so the shareholder doesn't even know how their money is being spent to, in their view, make their country worse. The chair talked about cryptocurrency, and I do have a few comments. The U.S. dollar is an extremely good currency, a medium of exchange, a store of value. It fails, however, to meet the needs of tax evaders, terrorists, sanctions evaders, and drug dealers. Hence, there's a market for an alternative based on those four markets. And the tax evader market is the giant share of that market. The SEC is going to have to construe laws, and one principle of construing laws is to do so in the public interest. It is not in the public interest for you to facilitate the creation of a device chiefly used by tax evaders, terrorists, and sanctions evaders. It is pretty clear that the Libra will be a mutual fund. I would put it, Mark Zuckerberg has a lot of money, but he doesn't have the power to print more. He will have that power if Libra each fulfills all of its expectations. It will be called Libra by them. I call it the Zuck Buck from Mr. Zuckerberg. Please do what you can to stop this. It meets no need for anyone who wants to follow our laws. And if you read the statements of those who want to disempower the federal government, they are thrilled with cryptocurrency in each of its developments. Now, a Small Business Investor Alliance, a small business investment company question. This Congress last year, in a House report, said that exempting BDCs from being covered by the AFFE rule dealing with expense reporting, given their similarities to operating companies, which are not covered by that rule, and the special role as capital providers for small business, will result in positive results for managers, improving corporate governance and transparency. So I would hope there was a positive development when you issued your proposed fund of funds rule. I hope that you would take steps so that BDCs can once again be portfolio investments of mutual funds and get the kind of analysis by analysts who are doing the work, which will then benefit private investors as well. Chairman Clayton, any comment on BDCs?
I think you framed it well. It's part of our fund of funds proposal. There is the tension there. Is it multiple layers of fees, or is it closer to an operating company? I think I want to commend our staff for the thorough way and that they're looking at this.
I think it's closer to an operating company. It's not just me. That's a House report.
I understand and just wanted to frame the issue.
Speaking of Cecil, our Constitution calls for government power to be exercised by those who are elected. FASB exercises government power, but not only are they not elected, they're not even government employees. They derive their power from you. And I talked to Mr. Roisman in my office, and he was of the view that perhaps you shouldn't exercise any oversight over FASB's substantive decisions. That would be a constitutional travesty to think that you could go to jail for violating a rule promulgated by someone who isn't even a government employee or elected official, and that rule has not even been substantively reviewed by anybody who is. But worse than a constitutional travesty, it's an accounting theory travesty. It is a terrible proposal, and its only defense is that its adoption will cause banks to have higher reserves than the bank regulators think they want to impose. And I would say, please do not use your power to delegate power to some folks up in Norwalk to impose bank regulation that they think is appropriate when we have already established bank regulators. I have a lot of questions for the record, and I yield back.
Thank you very much. The gentleman from Florida, Mr. Posey, is recognized for 5 minutes.
Thank you very much, Madam Chair. I appreciate your and the ranking member's leadership in holding this hearing. The work of the Securities and Exchange Commission is important to protecting investors, and I also want to thank each and every one of you for appearing today. It's been nearly 10 years since Alan Stanford was arrested for running the second largest Ponzi scheme in the history of the United States and the collapse of the Stanford Financial Group. Over 21,000 victims of Mr. Stanford's crimes, mostly hardworking, middle-class Americans, some of which reside in my district, have yet to be repaid in any meaningful way at all. The Stanford victims have received approximately 4.5 cents on the dollar, while the seemingly more influential or well-connected victims of the Madoff Ponzi scheme have received 75 cents on the dollar recovery. This result is really difficult for the public and me, quite frankly, to understand, and obviously it is not acceptable. Of the more than $5 billion in losses, the court-appointed receiver has recovered just $750 million. But what is more appalling than that is that nearly 50% has gone into the pocket of the receiver. If it couldn't get any worse, the receiver recently used his authority to bar individual investor claims against the banks who potentially aided and abetted the Stanford fraud. In fact, one of my constituents, Annalisa Mendez, and a dozen other victims recently wrote to the receiver and asked them if they might consider changing their course, to which the receiver did not even give them the courtesy of a reply. So I would like each of you to express to me or respond to the question of whether or not you think it's appropriate to bar investor claims in a case that has returned investors only 4.5 cents in 10 years. And we can start with Mr. Roisman and go right down the line.
So thank you for bringing this topic up. Obviously, it's a travesty is the right word. A travesty is the right word. I think if there is a means for collecting for wrongdoing, we need to ensure that that is something that people can count on to collect. If we don't have an adequate system, it creates questions and shakes our confidence not only in the financial service industry, but the oversight of it.
Okay. Ms. Peirce, Commissioner Peirce?
I'm happy to look into that issue. I'm not familiar specifically with the issue of the receiver barring investors from pursuing claims against banks. I'm happy to look into it and get back to you.
Well, thank you. Chairman?
I'll try to be brief to give my colleagues time, but I've actually spent a lot of time. I've spent a lot of time on this. I've met with the victim groups. I went down and met with the receiver and the examiner about 10 days ago. This is not an acceptable result at all. With respect to your specific question about the bar, there's a judgment to be made there. Minds can differ. I'm aware of the issue, and we're continuing to look at it. But rest assured, I've been fairly fully briefed on this issue.
Do I have the understanding that you're going to do more than observe it? Do you plan any engagement? Do you foresee any engagement? Do you foresee the cavalry coming to help the victims?
Let me say this. I am looking for any opportunity to help the victims get more money back faster.
Okay. We'll have another question about possible solutions you can be thinking about in the meantime. Commissioner Jackson?
Congressman, thank you for bringing this to our attention. I think Commissioner Roisman put it just right. This is a travesty. And like Commissioner Peirce, I'd be happy to look into this more deeply. Of all the things you've said, sir, what's most troubling is that you have a constituent who didn't get a response. And any American investor who's been involved with this situation is entitled to that. So I'm happy to look into that further, sir.
Thank you. Commissioner Lee?
Yes, I agree, and I will say that in my experience as an enforcement attorney, I've seen firsthand the damage that's done to victims such as your constituents, and I find it extremely troubling. So I wholeheartedly support any effort we can make to return more money to those investors, and will work with my colleagues to do so.
Okay, my time's about to expire, so I won't get to ask the other questions, but I would appreciate it if you would let my office know of possible solutions you have in mind or might be able to come up with, or anything that you think Congress could do to empower you more to do something about this. My time is up. I yield back. Thank you, Madam Chair.
Thank you very much. The gentleman from New York, Mr. Meeks, who is also the chair for the Subcommittee on Consumer Protection and Financial Institutions, is recognized for 5 minutes.
Thank you, Madam Chair. Let me try to get into, I got a few issues that I want to deal with, two separate. One is a practice that I'm concerned about is the growing practice of activist hedge funds attacking closed-end funds. These proxy contests and related lawsuits by activist hedge funds are not about improving governance, but rather about coercing closed-end funds that cannot adequately protect themselves. These hedge funds are evading the 3% limit specified in the 1940 Act through the use of multiple intermediaries, which they control. So this causes the closed-end funds to be either liquidated or severely impaired for short-term profits. The losers thereby are the mom and pop retail investors. So, Mr. Commissioner Jackson, would you agree that this practice is, one, illegal, and two, what is the SEC doing to curtail these activities?
Thank you, Congressman. Without commenting on any particular practice, here's what I want to say. I share your concern, sir. And in fact, one of the things that's most troubling about this is that closed-end funds ordinarily are held by retail investors, ordinary buy and hold mom and pop investors who bought the fund on the understanding that it wouldn't be attacked in just this way. In this area, sir, I'm guided by the evidence. I helped to write a paper a few years ago to show that when takeover defenses were called into question by the SEC some time ago, it hurt ordinary investors. This actually hurt the value of closed-end funds. So I'm committed to working on this subject, sir, and I look forward to working with my colleagues on the Commission to make sure that those ordinary mom-and-pop investors and closed-end funds are protected.
Thank you. Let me move to the next issue, which was, just last week, and I say address this to Commissioner Clayton, interest rates in the repo market skyrocketed, causing the Federal Reserve to announce it would inject around $400 billion into the market. In 2010, the SEC proposed a short-term borrowing rule in response to Lehman's lack of disclosure in its repo liabilities. The SEC's proposal stated that a critical component of a company's liquidity and capital resources is often its access to short-term borrowings for working capital and to fund its operation. If this rule had been finalized, investors and the public would have much greater information about the obscure repo market. So, Chairman Clayton, given the concerning market fluctuations of the past few weeks, don't you believe the SEC should finalize a repo disclosure rule?
Thank you for that question. I agree that understanding liquidity needs is, well, let's put it this way. It's essential to good oversight, understanding liquidity needs of our market participants. That rule that was proposed, in the time since it was proposed, there have been a number of developments, including disclosure requirements by our other federal regulators and at the SEC and accounting rules. And in fact, just the other day, we put out revised Guide 3, which addresses some of these issues. But you're right to raise the question as to whether we have sufficient insight into the liquidity in the repo market, something that we and our other federal regulators should be looking at. But what I can say is many of the issues that were to be addressed in that proposal have been addressed in other ways.
Should we be nervous about the economy of this going over, leveraging over, so that it has an effect? Because we don't ever want to go back to what took place in 2007. And recently in an article that came out last week, I noticed a number of financial newspapers, et cetera, has risen some concerns about where we are.
Look, liquidity is the lifeblood of modern economies, credit-based economies, which is what we have. And we should always be mindful of whether there's sufficient liquidity in our important markets, including our overnight markets. So
Let me ask another question, another area in the little time that I have left. The SEC has a voluntary diversity disclosure assessment program, but there is a response rate of only about 5%. I have a bill that would make such disclosures mandatory. In the meantime, what can the SEC do to ensure companies are releasing this important information to investors and the public?
So I think it was decided in 2015 that I'll call it a survey, would be done on a voluntary basis. I've met with our OMWI director on several occasions to try and facilitate greater responses. I think the 5% response rate is number of firms, but not number of employees covered. I don't have the exact number of employees, but Pam Gibbs and I are working to try and improve those numbers.
Thank you. The gentleman from Missouri, Mr. Lukemeyer, is recognized for 5 minutes.
Thank you, Madam Chair. Mr. Clayton, Chairman Clayton, I want to follow up on something that Congressman Sherman was discussing a minute ago with regards to CECL. His conversation dealt with Mr. Roisman, and I know I've written a letter to you with regards to SEC asking for a delay in study of CECL, whether it's appropriate or not, and you, in your letter, stated that SEC's mission does not typically involve macro-level studies on the impact of accounting standards on financial markets and the U.S. economy. This is an endeavor best pursued by the relevant federal financial regulators. As an aside, they all seem to think that nobody should be doing this. They always I get this point, everybody's pointing every other direction here, and nobody wants to do anything. I get the regulator two-step. But for the moment, let's say I agree with you that the SEC does not typically do macroeconomic studies. You are a member of FSOC, though, are you not? As a member of FSOC, have you requested of the Office of Financial Research to do a study?
I have not.
That is their job. Why have you not done that?
The question, let's take a step back. I agree with you that if something is going to have an adverse impact, if we're going to choose a measure and then people are going to manage to that measure for a non-prudential reason, and it's going to have an adverse effect on our economy, we should be rethinking that measure. I think in the area of CECL, what we've seen is FASB say, for a number of entities that this would apply to, maybe we should take a step back and evaluate its initial implementation. I think that's been a wise step.
Well, if you were proposing this rule, would you do a study?
If we were
yeah, I mean, Mr. Jackson a minute ago, he talked about he required data to make a decision that he came up with whether he was going to support something. I assume you would do the same thing, would you not?
Generally, in our rulemaking, we do economic analysis.
If somebody brought to you a problem, I'm sure you would ask them, document the problem, show us the data on why you believe it's a problem and why we should address it. Would you not look for the data there to support their assertion?
So, in most cases, yes. I mean, yes, I'm very interested in relevant data. This one is, report how you're doing, report how you're managing it. You and I have discussed this. I think you have a very valid point here, which is we're trying to provide insight into loan losses, or at least the standard is. And the question is, in providing that insight, are you changing behavior when that should be done by some other entity?
Let's analyze that for a moment. FASB says the reason they're doing this is to have better transparency on the balance sheet with regards to the risk of home loan mortgages on the balance sheet. Yep. The problem with that, as investors have been telling me, it's supposed to be for the investors. If the investors are telling me, say, look, now instead of as a uniform model across all of the institutions that reserve exactly the same, now we have a different model for every single institution. So now it's more confused and more difficult to look at than it ever was before. So this is going to confuse and make the issue more difficult to actually assess risk than it is going to be helpful. And I think a study would also show this. So, I guess my question to you is, as a member of FSOC, would you be willing to go to the board and request that Office of Financial Research do a study to see if this is something that we need to take a look at?
So I'm not going to commit to that specific course of action, but what I will commit to do is to continue to discuss this with my fellow FSOC members, raising exactly the points you've raised.
Well, Mr. Chairman, I'm going to give you an example I gave to some of the other regulators And we just celebrated the 50th anniversary of the man on the moon. How would you like to be in a lunar module on top of a rocket, knowing that the previous rocket, i.e. Mark to Market, which did not have any study or any cost-benefit analysis on it, in other words, the rocket wasn't tested, blew up on the launch pad. Now you're sitting on the launch pad with another rocket, i.e. Cecil, which has not been tested, i.e. a study or a cost-benefit analysis. Are you ready to light that rascal?
I would not want to be on that.
Thank you very much. That's the exact answer I got from every single regulator when I gave that example. So I think it's time we stop and study. I'm not asking to do away with the rule. I'm asking to see the impact of this. This is going to be, in my view, ginormous, the impact it's going to have on this economy, and to not do our oversight job here, which is to make sure this is going to be something that's going to be helpful rather than hurtful, is I think we're dropping the ball. One last comment.
Look, I will continue to engage on this. And I think that the points you're making are ones that we should think about.
I hope you were able to go to the FSOC and request the study. Thank you very much. I yield.
Thank you. The gentleman from Missouri, Mr. Clay, who is also the chair for the Subcommittee on Housing, Community Development, and Insurance, is recognized for 5 minutes.
Thank you, Madam Chair, and thank the witnesses for your participation today. Commissioner Jackson, the use of the practice of stock buybacks skyrocketed after the enactment of President Trump's Tax Cuts and Jobs Act. The tax bill provided significant tax benefits to large corporations, such as a lower corporate tax rate and an incentive to repatriate offshore cash, and according to one study, led to a 64% increase in stock repurchases while real wages for workers remained flat. Indeed, analysts estimate that in 2018, corporations used nearly 60% of their corporate tax cut to repurchase stock. In other words, at a time when wages for average workers have failed to keep up with inflation, corporations have used the corporate tax break to collectively pay $1 trillion to executive boards of directors and large shareholders, seemingly at the expense of small investors. Instead, firms could dedicate this capital to worker wages, training, hiring, and other investments necessary for innovation and growth. What is your view of stock buybacks, and should they be curtailed when used in a way that contravenes public policy?
Thank you, Congressman. So I want to make 2 points in response to all that you've said. First, I released research earlier this spring and last year to show that our rules right now allow executives to use a buyback as an opportunity to cash out their personal shares. And sir, if I were an ordinary buy and hold investor, I'd be confused that the company thinks the stock is cheap enough to buy, but the CEO would like to sell it. And for me, that raises a real conflict of interest problem that deserves more attention by corporations and by regulators. But second, sir, I'll say you're right. The use of buybacks has skyrocketed, and we haven't looked at those rules in long over a decade. I think it's time for us to dig into those rules and see whether they're protecting investors, and that's why I've called for an open comment period for us to review our buyback rules.
Wow, I mean, you lay out an analogy that's really troubling when you think about it. Is the confidence going to be there by those smaller investors? Interesting. Commissioner Clayton, many pension funds, including some in the state of Missouri, invest in private equity. Can the taxpayers and retired workers in my state be assured that there is adequate oversight of private equity by the SEC?
So I think what people should understand is that our oversight of the private markets, including private equity, is not the same as our oversight of the public markets. It's one of the reasons why it bothers me that more growth capital is being raised in the private markets. But to your specific question, we do inspect and regulate that market, albeit in a different way. And I was talking to our head of inspections recently about this. We were talking to him, and it continues to be a focus, particularly in the area of disclosure of fees. But yes, we do regulate it, not the same extent as we do the public markets.
Can retirees and taxpayers be confident that those investments are protected and that there will be a dollar for dollar retirement for people that depend on those retirements?
Look, what I'm going to say here is, I think if you look over a 20-year period, money managers who've had a mix of private equity, public equities, that's been a fairly standard and successful way to do it. If I'm looking out over the range of investment options as a professional investor, and I'm seeing that a greater percentage of capital is being raised in our private markets, I got to allocate, at least think about allocating some money to that. So we need to be cognizant of that in the way we look at regulation. So, I'm not going to substitute my judgment for the judgment of a money manager, but looking on a macro basis, if I were in that position, I would be looking at that as an asset class worthy of consideration.
I see. Well, I thank you both for your responses, and I yield back.
Thank you. The gentleman from Kentucky, Mr. Barr, is recognized for 5 minutes.
Thank you, Chairman Clayton. Business development companies are an important source of financing for small and mid-sized businesses in my state, having invested almost $300 million in Kentucky. I don't need an extensive response on this, but I do want to express my support for rationalizing how BDCs are treated under the acquired fund fees and expenses rule. I understand that the SEC staff is presently considering this issue, and I'm interested in a favorable resolution because BDCs have been so important to financing in Kentucky businesses. I do want to ask you a question about leverage lending because of the attention that it's received recently and alarm about rising corporate debt. Private credit fund managers, CLO managers, and other non-bank lenders often must register as investment advisors with the SEC. This results in substantial reporting requirements, regular SEC examinations, and activity limitations. Some members of this committee have voiced concerns about financial stability with respect to leverage lending and other non-bank lending activity. In my view, these concerns fail to take into account the role that the SEC plays in overseeing participants in this market. Chairman Clayton, as a regulator of private credit funds, can you discuss how your agency oversees their activities and how you are sharing this information with prudential regulators?
So I'm going to do this on a little bit broader basis, but what we should recognize is that our economy has grown since, let's just pick a date, 2010. It is a credit-based economy, but the amount of credit that's provided directly from the banking sector has gotten relatively smaller. That means the non-banking sector has to have gotten larger by kind of simple math. We recognize that. We are discussing that with our colleagues at the Fed, the FDIC, OCC, and others. But that is the reality. More of the credit that is underpinning our economy is outside of the banking sector and in the private sector, including in funds.
Given your oversight over investment advisors, though, do you see a systemic issue at this point?
If I saw a systemic issue, I would be doing something about it.
So the answer is no.
The answer is no.
Okay. Let me move on to Commissioner Peirce. Commissioner Peirce, as you know, the Business Roundtable recently published a revised statement of purpose, despite some BRT leaders' insistence that it's merely a restatement of existing practices. Some on this committee, as would have been predicted, have interpreted this as a shift away from the bedrock principle that directors and officers of a corporation owe an undivided fiduciary duty to maximize shareholder value. In other words, the primary job of a corporation is not to engage in social engineering. It's not to engage in politically correct causes. It's to maximize shareholder value. That's not to say that a company's social concerns, environmental considerations, or activities to ensure the well-being of employees, suppliers, or customers are irrelevant. It just means that shareholders may very well care about those issues and that the market may dictate that they help drive profitability. So, Commissioner Peirce, can companies effectively serve their customers, employees, suppliers, and communities without an undivided focus on maximizing shareholder value?
I think the singular focus on maximizing shareholder value is very important. It holds managers, it disciplines managers and forces them to focus. And obviously, as they're fulfilling that mandate, they're going to think about the communities they work in. They're going to think about their employees, and they'll think about suppliers as well. So the focus is really important.
So the ancillary goals, like those set forth in the BRT Statement of Purpose, aren't those ancillary goals, those secondary goals, aren't they predicated on a business delivering a profit and maximizing shareholder value?
Yeah, I mean, this is how companies have always run. They've wanted to serve their customers well so that they can serve their shareholders well.
Chairman Clayton, when asked about environmental, social, and governance metrics, investing in an interview last week at the Delivering Alpha conference, you noted that lumping E, S, and G together is difficult because they are quite different. And Commissioner Peirce, you have described ESG as scarlet letters that stand for enabling shareholder graft. Shouldn't the central focus of SEC disclosures be to provide material information to the investing public? And Chairman Clayton, can you discuss what the Commission is doing to ensure that materiality remains the touchstone of our markets?
Well, I very much believe that materiality should be the touchstone of our markets. And as our markets change, what may be material does change, which is why we need to have a principles-based approach to disclosure.
Thank you. I yield back.
Thank you. The gentleman from Georgia, Mr. Scott, is recognized for 5 minutes.
Thank you very much, Ms. Chair Lady. Chairman Clayton, let me ask you this. I want to talk to you about the LIBOR transition. Very critical for our financial system. As you know, the banks who are submitting the reporting information used to determine the LIBOR rate will no longer be compelled to use that in 2021. This is very critical. It is the benchmark that's underlying $400 trillion in contracts globally and $200 trillion in contracts right here in the United States. What is the impact this will be on our financial system?
Look, it's good that you raised this. This is an issue that requires attention. Shifting from LIBOR to an alternative rate, and one of the rates that has been proposed is SOFR. There's going to be some friction because one is sort of a bank rate and the other one is a secure funding rate. Or we need to reduce those frictions as much as possible. There are a number of ways to do it, but the numbers you cite are exactly right. If we're talking about $200 trillion outstanding now or $40 trillion that's going to survive the date that LIBOR is scheduled to go away, even small frictions create big numbers.
Yeah. Now, you raise an interesting point because one of the very critical issues we're faced with now is the need for financial education. It is very critical. We have 58, 60 million unbanked, underbanked folks. And here's my point. You know, I grew up in a little town in New York called Scarsdale, New York. And when I was in the 6th grade, our 6th grade project at Fox Meadow Elementary School was for us kids to go out, earn our own money, and do the research. And then as a class, we went down to the New York Stock Exchange and bought stock. That was so profound in my life. It was pivotal. And it led me on to being able to buy stock every year. I used that to start my own business, made it up to the Wharton School of Finance. They put me on the executive board of directors. And you know what? With John Scully, who was chairman of Apple, and he was chairman of our committee. And we would go across this country into African-American communities, building wealth. And the number one tool we used was investing in the stock market. Now, do you know that there are less than 17 state school boards association who require teaching of financial education. That is so critical. So I want to ask you, you're right at the step. Nobody can come out and be as strong and be an advocate for financial education mandatory in our schools. It could start at junior high school before the kids get it. Many don't even know about a checking account. And who are they left with? The predators, the people out there. Tell me, are you all as serious about this issue as we are? We on this committee are making that a priority. Ms. Beatty, Ms. Maxine Waters, and all of us are dealing with this issue. Just passed the bill to mandate the the Consumer Financial Protection Agency, Consumer Affairs, to start moving in this. Can you help us? Can we start a national movement to mandate the teaching of financial education in our schools? I'd love for it to start at the 6th grade. Thank you. What are your thoughts on that?
So I try very carefully to stay in my lane, Department of Education, SEC. I could not agree with you more about the importance of financial literacy and financial education in our country. It's not just for investing, it's for opportunities. If you don't have the vocabulary and the tools to participate in our credit-based economy, your opportunities are limited. End of story.
All right. Now, I wanted to ask you, Ms. Peirce, about financial fintech harmonization. Ms. Waters and I are working on a bill for that, and you gave a speech in Singapore on that. Could you tell us what is the state right now of regulatory affairs with fintechs? Could I ask for
Give the gentleman the courtesy of a short response.
Oh, you're so kind. Thank you.
I think we have to take into account that there's a lot of activity happening outside of the United States, and I'd like to try to bring more regulatory clarity in the U.S. so that fintech development and innovation can happen here.
Thank you very much.
Thank you, Chair.
You're welcome. The gentleman from Colorado, Mr. Tipton, is recognized for 5 minutes.
Thank you, Madam Chair, and I appreciate you all taking the time to be able to be here today. And Chairman Clayton, I would like to associate myself with the comments of Mr. Luchtmeyer in regards to CECL, to be able to pick that ball up and to carry it. Talking to a lot of our banks, a lot of our folks in our district, this is an important issue. And I think that while the intent wasn't, I'm sure, to be able to do some harm, it has the potential to actually impact us back at home and some of our economies. And I think being able, as Mr. Jackson had noted, to be able to do the studies, I think is something that is incumbent on us to be able to follow through on. But did want to make that comment, and did want to note that I was pleased to see this year that you'd established the Office of Advocate for Small Business Capital Formation. And would you maybe expound a little bit on what that office is doing and what you hope it might do for the Commission going forward?
So actually, thank you for the opportunity to do that, because I think this office is a very important office for the Commission, but also for our economy. Capital formation in the small business area, we all know that it's important. Are there regulatory impediments that we can lift without jeopardizing investor protection? That's kind of one of the things we're focused on. That's on nuts and bolts of what we do. Another thing that we're focused on is, what are the elements of an environment that drive small business capital formation? You see pockets of entrepreneurship around the country. You know, we all know about Silicon Valley, Route 128, Austin's coming on, Nashville. I don't want to leave anybody out. But what are the elements that exist in those places, and how can we replicate them in different parts of the country? Particularly in the middle of the country, entrepreneurship is relatively anemic in the middle of the country compared to the coasts, and we want to do something about that.
Well, and I appreciate that, and particularly looking into the segments that you're mentioning. One area, myself along with some of my colleagues through the Small Business Caucus, have been dealing with is in terms of lending to women-owned businesses. There is a huge gap in terms of the lack of participation, if you will, in terms of loaning to women-owned businesses? Are there some areas that you're seeing the opportunity to be able to expand and to encourage that?
I agree. I agree that that's an area we should focus on.
Okay. Commissioner Peirce, you made some comments, and I think that it falls in line with the chairman's comments in terms of looking at some of the regulations that we have in place. Are they a burden or not? You were talking about some of the data collection in your opening statements. Do you see the opportunity? We all want to be able to have the guardrails in place to make sure that the economy is moving, that we know the rules of the road, but we can get to that burdensome point. We're inhibiting the ability to be able to invest dollars, to be able to raise capital. Can you expand on that just a little bit more?
I think the chairman and his director of corporation finance, Bill Hinman, have really been taking a very close look to see where we can get rid of duplicative requirements and we can streamline existing requirements. The chairman mentioned trying to focus more on principles-based requirements that are more, they last better over time because they change with the different reality that companies are facing. So things like that can seem small, but they can make a huge difference for companies that are engaged in trying to raise capital here in the U.S.
Okay, thanks. Chairman Clayton, with states like California coming out with extensive privacy laws, has the SEC considered developing additional rules and regulations in the areas within the Commission's jurisdiction to make sure that Americans, regardless of the state that they live in, understand what can and can't be done with their data?
I can't tell you that we've had a specific focus on a data privacy disclosure. I think what you're talking about is a data privacy disclosure for, say, broker-dealers, registered investment advisors dealing with their customers. That we have not taken up that initiative specifically. I understand the issue you're talking about is that, what kind of disclosure. I think that's also in the consumer space, but you make a good point.
Okay. Thank you, and I yield back, Madam Chair.
The gentleman from Texas, Mr. Green, who is also chair for the Subcommittee on Oversight and Investigations, is recognized for 5 minutes.
Thank you, Madam Chair. Mr. Chairman, is it fair to say that we have two products that we are dealing with, the Libra coin being one and the Libra investment token being another?
Again, I don't generally talk about specific products or assets, but as I understand your question, it sounds like they're two different products.
All right, thank you. And is it true that, in your opinion, if the coin does not produce a return on investment, it's not subject to security regulation, SEC regulation?
So again, I'm going to step back and talk about assets generally, crypto assets. A statement such as, if it doesn't produce a return, it's not a security, I think that's a bit of an oversimplification.
May I ask this? Generally speaking, let's not have it be a cryptocurrency. If a product does not produce a return on investment, is it something that you regulate?
If what you're saying by a return on an investment, does it give you rights in an enterprise? Or is it somehow packaged as a product that is designed to give you a return on your investment? Those are the types of things that are securities. I
understand. I use that terminology because you used it earlier when you were giving your statement.
Yeah.
Okay, so let me just walk through something, if I may, because this is, I think, worthy of consideration. As proposed, Libra will be backed by the Libra Reserve, and the reserve will be managed by the Libra Association. The association will have members. The members of the association will invest some $10 million into something called the token, the Libra token. The token investors will receive dividends generated by the yield of the assets held in the reserve. I'm sure you're familiar with this because of the position you hold. If all of this comes together, it seems that we have integrated the token into the coin in some way, such as to produce a return which would then deem it to be a security, not specific to Libra and the token, the coin and the token, but generally speaking, would that kind of transaction make it a security?
So I want to commend you on your understanding of the securities laws and the question you asked, because it's quite a sophisticated question that I believe a lot of lawyers have probably spent a lot of time trying to find out where that line is, whether there's a sufficient amount of integration to cause something that would be a store of value to become just a simple store of value to become a security. I'm not gonna in this forum make a judgment on whether something is a security or not, particularly when we can't see how it's used. But you have articulated very well the kinds of issues that we're going to be looking at when we look at assets of this type.
Well, thank you. I will write a letter giving you my opinions, if I may.
Please, please.
Mr. Jackson, if I may. Pursuant to SEC rule that was finalized on June 5th, 2019, Reg B1, are investment advisors true fiduciaries?
Thank you, Congressman. My concern, as I mentioned I dissented from that, from the adoption of that rule, sir. And the reason is exactly as you suggested. That my view is that ordinary American investors have the following understanding. When someone's a fiduciary to me, they've got to put my interest first. And my own view is that the rule we adopted was not clear enough about that. For that reason, I dissented from the package you just described.
Well, I understand this is your position. Let me ask a chairman, if I may. I'm not trying to put you at odds with each other. I'm trying to get a better understanding. Is it your position that they are not true fiduciaries?
Here's the thing about a question like that. The term fiduciary means a lot of different things in a lot of different contexts.
Well, will they put my interests ahead of theirs if I'm the investor?
In both the investment advisor space and the broker-dealer space, the professional can't put their interests ahead of the client's. And for the first time, we've made that clear. If you're an investment professional, you can't put your interests ahead of your clients.
Thank you, Madam Chair. My time has expired.
Thank you. The gentleman from Arkansas, Mr. Hill, is recognized for 5 minutes.
Thank you, Chairwoman Waters. Thanks for having this hearing, and I want to thank the witnesses for being here. What a treat to have the full commission before the committee, and I certainly want to thank all of you for the public service you are doing and continuing in the 85-year tradition of the SEC of protecting investors and maintaining our remarkable capital formation across all of our markets. It's been a very interesting discussion this morning. I want to just tick down, as my friend from Colorado did, a few things of interest. I, too, want to associate myself with Mr. Sherman and Mr. Luetkemeyer on demonstrating leadership in the regulatory system about FASB proposals when they didn't even follow FASB's own rules under their pronouncements on how to bring that rule forward. So thank you for that discussion. I, too, have constituents who suffered mightily at the hands of Sir Allen and the Sanford Ponzi scheme. So that led me last week to support the co-cash clarification that came before our committee from Mr. McAdams. I'm not sure I'm keen on 14 years, but that was the compromise. I think 10 years is probably more in keeping with the tradition under these kinds of frauds. But I definitely appreciate his leadership on defining fine versus disgorgement versus restitution, which all 9 justices couldn't figure out. So I appreciate that. I also want to compliment Mr. Scott on financial literacy. Dr. Foster and I have been leaders on financial literacy bills in Congress. We support that wholeheartedly. And in Arkansas, we have Economics Arkansas, so we're proud to be one of those 17 states that, in fact, encourages economic curricula for our kids. Commissioner Peirce referenced CAT, the Consolidated Audit Trail. I, too, have concerns about that. I was very concerned about Rick Ketchum and FINRA's proposal to do the cards proposal 4 years ago. This is just turning the card over and it's a picture of a cat. It's all the same issue, which is, does government need to micromanage and have every trade for every person every day, when you already have the authority, in my view, at the Commission, to look for trades under your market regulation, market surveillance functions with the power that you have now. So I'm not a fan of cats as I was not a fan of cards. During this Congress, we've had a lot of discussion about capital formation, and it's interesting, and corporate governance, both in the committee over the past 9 months. Almost every proposal drives up costs of compliance and drives up costs of preparing a 10Q or a 10K for investors. And I find that frustrating because for the prior 10 years, this committee from both sides of the aisle talked about how do we lower, maintain transparency, maintain materiality, maintain important information for investors, but lower accounting costs, lower disclosure costs. How do we get at lowering officer and director liability, corporate liability expenses? How do we lower the costs associated with going public from a market reg point of view? So I'm concerned that we're going in the wrong directions in the debates here, and I urge the Commission to use your economic analysis, your cost-benefit and power that you have, to be focused on lowering the cost of being a public company, reduce barriers, and let's not blame Reg D streamlining in the 1990s for why we have fewer public companies. Let's embrace more of the Jobs Act and Jobs 3.0 approach. This slide I wanted to put up because over the last few days there's been a lot of conversation about this Business Roundtable report, this release back in August, and those on the left jumped on screaming victory that by God they had cowered the Fortune 200 into doing things their way to have a more socially sensitive boardroom. Those on the right screamed bloody murder that, oh my gosh, we're going to abandon shareholder returns. And then this morning on CNBC, my old pal Nell Minow postulated a new cynical theory for the BRT release, which is that because CEOs can't maximize earnings anymore because they can't buy their stock back, now they're going to tie earnings to some of these social goals. I put this up from 1992. This was our publicly traded company in Little Rock, where we had shareholders, customers, and bankers, all priorities of our company, in the communities we serve to do what? Drive financial performance. And we were a top-rated, top-performing bank holding company. I don't think the BRT change was that big a deal.
Thank you. The gentleman from Missouri, Mr. Cleaver, who is also the chair for the Subcommittee on National Security, International Development, and Monetary Policy, is recognized for 5 minutes.
Thank you, Madam Chair. Thank you for being here today. On the 27th of February, excuse me, I sent a letter to the Financial Stability Oversight Council, FSOC, which you are also members, and the Office of Financial Research, and to the CEO of Facebook, Dave Marcus. And I received an interesting response, and I would like to have it entered into the record, Madam Chair.
Without objection, such is the order.
Let me just share just a bit of it because I think it's critically important. The chairman says the U.S. Department of Treasury requesting a review of Libra and Calibra wallet by FSOC and OFR. And he says, we agree with you, Chairman Cleaver and Chairwoman Waters, that these projects should be subject to regulatory review. And they said that they would agree to furnish any and all information needed for any investigation or any review of FSOC or a review that FSOC or OFR may be interested in conducting. And I thought that was significant. We agree with your view that FSOC and OFR are qualified to assess the development of this work and that FSOC can play a valuable role in coordinating among its member agencies to ensure regulatory concerns are addressed. And then they concluded by saying, we will not launch until we have addressed all U.S. regulatory concerns. Now, Mr. Chairman, I know you said you didn't want to become involved in any product, but I have a Bloomberg article, August 27th, where you addressed this issue of sorts. You said, and I quote, if it looks like an ETF and operates like an ETF, the law says it should be regulated like an ETF. So can you provide some greater clarity?
No, I think that's I like that statement.
I do too. Just
I like that statement because if what the product is something that is like an ETF on currencies, then we regulate it.
So they're saying they're not going to launch until they've addressed all regulatory concerns. Is there any concerns that have been expressed to Facebook as it relates to whether or not they're going to implement the Libra?
I guess, as Commissioner Peirce noted, we have a group that is looking at these things, and our doors are open. People should understand that as a general matter, if a digital or crypto asset is looking like or a substitute for something that's a security, they should come in and talk to us and find out whether their view of the world is the same as our view of the world.
So would it be something, I mean, it's not anything that would be initiated by the SEC, is that what you're saying?
It can go both ways, but I want to make it clear that our doors are open to talk about these things, and if somebody's going to launch something without coming to see us first, I think that's a bad idea.
I do too. I yield back to Ballas on my time.
Thank you. The gentleman from Georgia, Mr. Laudermilk, is recognized for 5 minutes.
Thank you, Madam Chair. Thank you all for taking time to be here today. I want to start off talking about something that's been slightly touched on here that I think of all that you and we have a responsibility for is it's probably the greatest threat to businesses, investors, as well as average Americans, and that's cybersecurity. I think it is the greatest and growing threat to our nation, to individuals. The threat of identity, information, personally identifiable information, critical business, government, personal data. Sometimes I'm a voice in the wilderness on this issue, but it is significant in this nation, and we have to spend a lot of time and attention to it. Now, when I bring this up in different committees and talk about this, usually the response I get is, well, this is the investment we're making in cybersecurity or cryptology or in protecting the data we have, but we overlook a basic premise of data security. I spent 30 years of my life in the IT sector. I spent part of my time in the Air Force and intelligence where we dealt in securing data. There was a basic principle was you don't have to secure what you don't have. Meaning if you don't absolutely need the information, then don't get it, don't keep it. I'm getting to CAT, the Consolidated Audit Trail. I am gravely concerned over the Consolidated Audit Trail because you're talking about getting up to 60 billion records per day with a lot of PII in there, information on individuals, on businesses, transactions. This, in my opinion, makes you a prime target for nation state actors, for cyber criminals, and in this environment, it is more than a full-time job to stay ahead of the bad actors. I mean, if you drop your guard for 1 second, a lot of people are harmed. Ask Equifax. They're proof of just laying down on the job for 1 second. So I know that the SROs have proposed eliminating the collection of Social Security numbers, account numbers, and dates of birth, moving forward with the Consolidated Audit Trail. But there's still discussions of including investor names, years of birth, and addresses, which still is a concern of mine. So, Mr. Clayton, does the SEC support the SRO's proposal of eliminating at least that information?
So backing up, I agree with you that you have to ask yourself in this society, do we need the information to do our job? And fast forward, I support it because I think we need that information, name, not date of birth, but year of birth, an account, to do our job. But I don't think we need much more than that. So I'm supportive of that outcome. I think that there was a lot more personally identifiable information that was in there that as we drilled down, we realized that eliminating those fields, we were not eliminating our ability to surveil the markets.
Okay. So the question is, do you need it? But the other follow-up question on that from a cybersecurity perspective is it data that you need to store, or is it data that you can obtain when you need it without having the risk of actually storing the data?
And that is a question that we asked ourselves. Do we have some kind of retrieve function to get the data? But you do need data. You do need enough data to know whether to retrieve something. So at that point, you're going from just account number, to name and year of birth. We're going to reach out for name and year of birth more. We're trying to strike the right balance.
Okay. Commissioner Peirce, I know that you've expressed some concerns about consolidated audit trail. I want to give you an opportunity to opine on my concerns.
I think you're raising exactly the right questions. We have to ask, do we need the data? If we don't need it, we shouldn't collect it. We have a system now that allows us to get data when we need it. It's the Blue Sheet system. We can do some work on it. It still does need some work, but I think it's a workable alternative. Query why we need all this retail investor information. I just don't think we need it, and I worry about it being an extremely attractive target.
Well, thank you both. I'm going to keep our eye on this and how it progresses, because I see that in a lot of instances in our government, we just love collecting data, and 90% of that data sits and it never goes anywhere. So thank you. You'll back my time.
The committee will stand in recess for 5 minutes.
about Libra. They still don't like Libra. Right. You got to cover that. We'll take populist headlines. Yeah. Right. 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 We don't do that a lot. As you know.
Yes. So surprised that we have the proxy box, which I feel is like top of the agenda. Yes. So you still plan on moving some sort of NPRM like proposal beyond the guidance that you guys put out on proxy?
So I just say chairman in charge of the agenda, and I just look at our reg points that usually tells us what we're considering.
But you're still working on it. There's still stuff you guys are working on.
We're working on a couple of things, but again, I think that's probably better suited for the chairman. But if you're I don't really want to. It's the staff guidance. Yeah. So, yeah. It's a staff.
Yeah. Hey, how you doing? Good to see ya. They said 5 minutes. David's sitting right there, so if he leaves, I'm leaving for lunch, but if not, I'm just going to miss lunch. I was just emailing, it's fundraiser. I think it was, I'll see you Friday. Yeah, exactly.
Almost all back. Who's next? The gentleman from Connecticut, Mr. Himes, is recognized for 5 minutes.
Thank you, Madam Chair, and I'd like to thank all the commissioners for appearing before us today. Mr. Chairman, I've had the privilege of serving with at least 3 chairs and a whole bunch of commissioners, and I'd really like to thank you for your work. This is as transparent, engaged, and helpful a commission as I've had the privilege to work with, so thank you for that. I want to focus on an issue that I've been working on for the last several years, which is the issue of insider trading. As you all know, insider trading erodes faith in our capital markets. It rewards insiders at the expense of often retail investors and is a real problem. And what our witnesses know well, but the American people may not, is that there is no statutory prohibition on insider trading. The SEC can and does prosecute insider trading through their anti-fraud and anti-manipulation authority, but the case law that shapes this insider trading law is far from a solid foundation. In fact, decisions like U.S. versus Newman can radically alter the landscape of what is unlawful almost overnight. I'm a believer that if we're going to prosecute someone for a crime, we should put that crime into statute, and that's what I've been working on for these last several years. And I'm very grateful both for the support and cooperation of the Commission, as well as the support of Chairwoman Waters and Chairwoman Maloney, as well as the cooperation of Ranking Member McHenry. As you know, we marked up a bill in the beginning of May, and in the spirit of getting to bipartisan agreement, we continue to work with the Commission and with my Republican colleagues to further refine the bill. I know you don't want to comment on particular legislation, but I want to get thoughts on some ideas that remain in discussion as we contemplate the bill. And those ideas are exclusivity and preemption. Chairman Clayton, let me start with you on the topic of exclusivity and just ask you to opine whether requiring that insider trading cases only be charged through the provision of law as envisioned in this bill, instead of also being able to rely on anti-fraud and anti-manipulation authority, would that help or hamper your ability to prosecute insider trading cases?
So look, I commend you for grappling with the issues that are most sensitive in insider trading, which is, when is the information that gives somebody an advantage acceptable for them to have that advantage? Like, you know, I go count boxcars and find out whether a company's lying, and if they're lying, you know, short the stock. And we want to encourage people to seek information, or information that's obtained in a bad way, which is, you know, you're the CEO of a company and you have information ahead of people and you trade ahead of them. We don't want that. And you're grappling with that issue, and you're grappling with the issue of, once I have impermissible inside information, when I pass it on, how liable are the people I pass it on to? And I think you're doing a terrific job on grappling with both those issues that the courts have grappled with. A lot of what's been built up over time, I wouldn't want to lose in terms of what we think is a good way to obtain information and what we think is a bad way to obtain information. So that frames my answer to exclusivity. I don't want to lose that body of law that we have built up over time. I understand the Newman decision was one that gave people some consternation. I think that consternation has been greatly narrowed in subsequent decisions. But my answer to your question is, let's not give up what we've learned over the course of the last 30 years enforcing this law in trying to improve it.
Thank you, Chairman. I appreciate that. The other issue, of course, is the age-old issue that we struggle with all the time, which is preemption of state law. And Commissioner Jackson, let me turn to you on this one. We are discussing that issue, which we always discuss. So my question, I guess, is if the bill, in fact, preempted the authority of states to investigate and prosecute insider trading, is it your sense that that would be a good thing, or would it sort of compromise our overall ability to deal with insider trading as a threat to the capital markets?
Congressman, thank you for your work on this. I agree with the chairman that what we really want to do is build on the long-standing law we've had in this area rather than undermine things we've got. And the reason that's true, Congressman, is that what we're trying to achieve is clarity, both for people on inside companies and for ordinary investors. We want to let people know what the law is. And if we make significant changes, for example, by getting rid of tools that already exist and have existed for many years, I think we'll create more, not less, uncertainty.
Okay. I've only got 20 seconds left here, so I want to thank you for those answers. I think those are an important contribution to getting us to a point where we can move forward with a bipartisan bill, which hopefully, and it has always been our intention here to not communicate, but to make good law. And so I appreciate the cooperation of the Commission. We'll continue to work with you and hopefully clear up some of the legal ambiguity in this area. With that, Madam Chair, I yield back.
Thank you. The gentleman from Ohio, Mr. Davidson, is recognized for 5 minutes.
Thank you, Madam Chairwoman. I thank the board. Chairman Clayton, as a successful Midwestern entrepreneur, I want to thank you for your role thus far in improving capital formation, particularly for small enterprises. Notably, raising caps from $75 million to $250 million was a big win. I do, however, want to highlight some risks. Recently, Director Bill Hinman stated in a fireside chat that the SEC prefers an approach to digital assets that through facts and circumstances rather than a bright line test. This company-by-company approach prevents regulatory clarity, and it suffers from some of the charm and inefficiency of third-world power structures. For this reason, although innovators are in America and innovations still occurring in America, capital is fleeing, not to avoid our regulations, but to find efficient regulatory clarity, and they're finding it elsewhere. We need a simple set of rules that apply equally and clearly to all. That is the premise of a bill that I know you won't talk about, but the framework that the market needs. Where is the capital going? Places like Singapore, the UK, Switzerland have laid out clear frameworks for digital assets. Meanwhile, in the United States, hundreds of companies await no action letters, with only 2 having been issued thus far by the SEC. Now, I agree with you that the ICO situation represents bad outcomes, but the root issue remains. America does not have a clear regulatory framework. Consumers and investors are harmed by that status quo. In fact, Director Peirce nailed the explanation. The SEC should not only be concerned about fraud, but also about opportunity. Our failure to provide regulatory clarity fails Americans on both counts. We have not become the world's land of opportunity, the best destination for goods, services, capital, intellectual property, and more by anarchy or by inaction. With respect to digital assets, it's time for deeds, not words. Director Peirce, in your opening remarks, you said enforcement is a poor way to announce policy. Would a law passed by Congress be an effective way to announce policy? Would that better enable the SEC, or for that matter, other regulators, to focus on consumer and investor protection?
It's always better to have a clear law that spells out what is and is not permissible, and I think then that enables people to make decisions around that law, and then we can enforce around that as well.
Thank you. And Commissioner Jackson, you referred to essentially the same sentiment that what the law is provides these signals for the market. And that's why I've introduced the Token Taxonomy Act. It's a bipartisan bill with broad support. It provides a simple set of rules for digital assets that apply equally and clearly to all. Moving on to another concern, last Congress I introduced the Market Data Protection Act, which passed the House but unfortunately did not clear the hurdle in the Senate. The bill required the SEC, FINRA, and the Consolidated Audit Trail's operator to implement internal risk control mechanisms to safeguard market data before the Consolidated Audit Trail could accept any such data. This spring, Congressman Loudermilk, who just spoke with you from our side of the aisle, and I sent a letter seeking the same assurances. I will submit further questions on this critical risk for the record in your subsequent response, but I am encouraged by the direction that the SEC has taken on this. So when you look at what was taking place when you first came in, I remember your first time here was one of my early hearings on the committee. And you had just found out, it had just been news, that well prior to you taking office, there had been data breaches of the Edgar system. And so even the internal controls inside the SEC, just like all the controls, once cyber's there, highlight how important it is to protect, diminish the amount of information that's collected, because then you have to safeguard it. And then I appreciate the attention you've paid to separating personally identifiable information from that data. When you link the two concerns I've talked about, I do hope that blockchain can play a role in the data security concerns that the country has. I truly believe that if we provide the regulatory clarity that the market is clamoring for, that we will see an era of flourishing in blockchain, much like what our country has seen with the internet. And America's interests were highly advanced by our providing that regulatory clarity. Otherwise, the innovation is going to happen elsewhere. And I believe failure to act is already accelerated that transition. So with that, I yield.
Thank you. The gentleman from Illinois, Mr. Foster, is recognized for 5 minutes.
Thank you, Madam Chairwoman, and thank you to the full commission for appearing today. Commissioner Jackson, there's been a lot of talk about mandatory arbitration of late. As you may have heard, the House has recently passed the FAIR Act, and I am sponsoring the Investor Choice Act, which would prohibit public companies from requiring mandatory arbitration in shareholder disputes. So could you say, from your perspective, could you tell us why allowing individual enforcement of securities laws in our courts is good for the public?
Thank you, Congressman, and thank you for your leadership in this area. It's extremely important. For me, here's what this comes down to, sir. What we're trying to do in this country is deter corporate insiders from committing fraud against their investors. It's good for the market, it's good for the companies, and it's good for investors. And there's many different tools we have across our market to achieve that. We have public enforcement of the securities laws, which our tremendous staff works at every day under Chairman Clayton's able leadership. We have private enforcement of the securities laws that occurs in our courts. And I guess I would say to those who want to do less with private enforcement, you kind of have three choices in this area. You can be for public enforcement of the securities laws, private enforcement of the securities laws, or fraud. And I, sir, would prefer the historical approach we've taken in this country, which is a mix of public and private tools that make sure investors are protected.
And isn't it true that individual suits on issues related to corporate fraud help return a very large portion of the ill-gotten gains to investors?
Yes, and in fact, as a matter of the data in this area, Congressman, the amount returned through private lawsuits is quite substantial and compensates American investors all the time.
Okay, and it's my understanding that currently there are few, if any, public companies that actually require mandatory arbitration in their governing documents. And so, to a large extent, this bill would simply be codifying longstanding practice. Is that also your understanding?
Without commenting on any particular legislation, I think it would be very important to send a clear message to companies about what the law is in this area. And to the degree that any pending legislation would do that, I would be very supportive.
Now, Chairman Clayton, I'd like to bring up the issue of the consolidated audit trail again. And first, could you just give us a very brief schedule update, which has not been, a thing of glory for the last decade?
Yeah. So it's way behind where it was supposed to be. But we've made some ground recently, and I think that we've coalesced around a schedule with the SROs.
What are the key milestones there?
The key milestones, there are a series of milestones. I can't remember them off the top of my head, but it starts with basic order data and goes through to a more complex thing. But it's essentially a series of let's just say 3 to 4 milestones that we now have clarity and agreement on whether on when we expect them to be completed. And we recently proposed, and I want to thank everybody here for supporting this, recently proposed a rule that would align financial incentives with keeping to those milestones. I think one of the issues here is that the financial incentives and the obligations may not have been as aligned as you would have wanted them to be.
Yeah, thank you. And one of the key issues here has to do with the beneficial entity behind, the trades. And it's my understanding from your testimony that there's been some motion away from, in terms of the personal identification of individuals there. And so there's sort of two issues there. First, do you plan still on having a unique identifier for every market participant? So you can, for example, identify wash trades and things like that.
So we would, what we want to have is enough individual information where you can see where the trade is coming from. And I think what we've settled on is, a unique identifier,
So there will be a unique identifier with the intention that no trader should be able to operate multiple unique identifiers internationally? Because that seems like that is a key part and a tough nut to crack.
Yes.
Yeah,
Yes,
so
it's a
what
key
is
part
your
and a
plan?
tough nut to crack, and we want to get there.
What is your plan, and what is the status of international agreements that might allow you to get there?
Now, you're actually raising another question, I think, which is if people outside the U.S., and this bothers me.
Sure. No, because clearly you can manipulate a price in the U.S. and make a derivative bet in London, and unless the regulators can see it is the same beneficial person, then regulation doesn't work. And so you must have a plan in the works to deal with that, I assume. What's the status of it?
Status is we need to deal with that. Do I have a specific plan? No, but it's an issue that's very important to me.
All right. Thank you. Yield back.
Thank you. The gentleman from North Carolina, Mr. Budd, is recognized for 5 minutes.
Thank you, Madam Chair, and again, thank you to our witnesses here. Chairman Clayton, it's good to see you, and again, thanks for your work at the SEC. I was pleased to see you take steps to ensure appropriate oversight of proxy advisors and establish much more needed rules of the road for this industry in your recent August 21 guidance. Proxy advisory firms have gained extraordinary and unchecked power in recent years, and I'm concerned that shareholders and fiduciaries are relying on their recommendations, which often contain factually incorrect information. While the recent SEC guidance is an important first step, I urge the Commission to expand efforts to increase transparency into proxy advisory firms and ensure that they operate in a transparent manner and provide accurate information to support voting decisions. So in your view, what more can the SEC do in this arena, and how can the Commission work with Congress to bolster these efforts?
So let me start by thanking Commissioner Roisman, who has taken the lead in this area. And then in response to your question, I think the roundtables that we had last year, where got a lot of input from various market participants, really show the areas that need attention. Do investors understand how the securities that they're invested in are being voted? They should understand that. Is our proxy plumbing where it should be? My answer to that is it's not. We should be able to know that when there's an election, the votes that are being cast are indeed representative of the number of shares and the ownership of those votes. We should be able to solve that problem. I think that's fairly straightforward. And then, just overall hygiene around the engagement process, and have we calibrated it correctly? We really haven't looked at the calibration around the shareholder engagement process with any great rigor in about 20 years or so. So a lot has changed. We have the internet. We have dissemination of information very quickly. We probably shouldn't have rules that were written for the males.
Thank you. Commissioner Roisman, I also want to thank you for your leadership on this issue. You just got a nice shout out on that. So same question, does the recent guidance from the SEC on proxy advisory firms adequately address this issue? And what more can be done to increase transparency and accountability for proxy advisory firms?
Well, thank you for the question, and I think that the chairman did a very good job of summarizing where we stand. I think we've had an interest in this area for a long period of time. I know members of this committee over many Congresses have as well, and in fact there's even been GAO reports to kind of delve into this. So what I would say is I think what we did in August was an important first step. I think we're constantly looking at other things such as the proxy plumbing. We've heard suggestions, things as like end-to-end confirmation, making sure that when people vote, those votes are counted. I think that's just critical to market and, frankly, voter integrity. And then things along the lines of potential other rules in terms of shareholder engagement. It's on our regulatory flexibility agenda, and to the extent that we get more comment on it, we would always input that in and make our best decision.
Thank you very much. Commissioner Peirce, again, welcome. So in April, FinHub published a framework for investment contract analysis of digital assets, which included 60+ factors for determining whether or not the SEC would consider a digital asset to be a security. So in a statement released alongside your framework, your colleagues Bill Hinman and Valerie Skapanik indicated that the framework is not intended to be an exhaustive overview of the law, but rather an analytical tool to help market participants assess whether the federal securities laws apply to the offer, sale, or resale of a particular digital asset. So based on your discussions with market participants following the release of the framework, has the guidance helped resolve their most important questions? And wouldn't it have been more useful to indicate in the framework how the SEC would weigh these 60-plus factors?
I think weighting is one of the things that people have told me that they really would like to have. The guidance was well-intentioned, wanting to give more clarity, but I think it did muddy the waters.
Thank you. So last question, when can market participants expect an exhaustive overview of the law so that they can get the regulatory certainty required to continue and innovate and create American jobs?
Yeah, I mean, as I said earlier, I'm hoping that we can work to create some kind of safe harbor, which I think would be probably the best way we could provide clarity, but I'm open to other suggestions about ways that we could provide clarity, particularly for utility tokens, which I think are a little bit different than some of the other types of digital assets we sometimes think about.
Thank you. I yield back.
Thank you. The gentleman from Illinois, Mr. Caston, is recognized for 5 minutes.
Thank you, Madam Chair, and thank you all for coming here today. One of the first hearings that we had here was with Jay Powell, and I had heard shortly before that day on the Science Committee that I also sit on, that if we eliminated all CO2 emissions tomorrow, we already have 2 feet of sea level rise baked in. And that's not only coming, but it's accelerating. And I asked Chairman Powell whether, given his Fannie and Freddie are in receivership, whether we should think about 30-year mortgages in Miami differently than we think about them in Denver. And his response, which I'll paraphrase, was something along the lines of, "That's a good question." I mention that because I have a real concern that we don't properly evaluate the risks that companies are exposed to from climate change, and it's why I introduced in the House the Climate Disclosure Act to try to quantify that risk. Commissioner Jackson, we know that ESG protocols provide qualitative disclosure of climate risks. Do you believe that adding quantitative and consistent disclosure is a good thing?
Again, Congressman, without commenting on any particular pending legislation, the answer to your question is yes, sir. That it's clear to me that the best way to hold companies accountable for the decisions they make in this and many other areas is to get them to quantify their decisions and disclose that number to shareholders.
Okay, and to be clear, I am as concerned about investors. I'm not naming and shaming as something that can be done, but if I'm an investor in a company that has a disproportionate exposure to climate risk, I'd like to know that. If investors don't have access to that information, of course, this is not just flooding. This is seed companies that may not have seeds that can grow in, the increasing droughts that we have in Illinois and floods we have in Illinois. How does the lack of basic access to that information potentially impact investors?
Well, what it does, Congressman, is make it difficult for investors to understand the risks they face in the companies they own. And that's why I think your leadership in this area has been so important. It's crucial that we let ordinary investors understand what the sustainability implications are of corporate decisions. And let me say something. I'm not the only one who thinks that. My own view is that we should be asking investors what they care about in this area. And, sir, here the evidence is crystal clear. You can see that many of the SASB standards have led to unusual returns, abnormal returns. Shareholders care about this. Very frequently, shareholder proposals ask for more transparency in this area. It's very clear to me that ordinary investors care about these details, sir.
Thank you. And the hope, again, assuming that we get this through, we've gotten it off of committee, we don't get to decide which accounting standard we're going to use. You all have a predilection for GAAP, which I appreciate. We do, at this point, still have wildly different ESG reporting standards, and the hope is that we can standardize and come up with a consistent tool so that when investors are trying to figure out what their exposure is to a rapidly changing world, they can quantify that in some kind of a consistent fashion. Any of the rest of you have any comments with the balance of time I have here?
I'll just say that I encourage shareholder engagement on all issues of this type with companies.
Okay. Thank you, and I yield back.
Thank you. The gentleman from Ohio, Mr. Gonzalez, is recognized for 5 minutes.
Thank you, Madam Chair, and thank you, everybody, for being here. It's been a Very good hearing. Chairman Clayton, I was very happy to hear your comments and your interest in seeing more companies go public and stay public. I share that so that Main Street investors can participate in some of our fastest growing, most exciting businesses. When I talk to investors or investors in these companies, private companies, or the CEOs or CFOs themselves, I hear kind of two areas. One is a barrier on the lack of research and liquidity in the market if you're a smaller microcap firm, as well as research. And then the second one is just what I would call just general pains associated with raising a public round, going through the IPO process as opposed to staying in the private market. So my first question, what is the SEC doing to increase the volume of the trading and the coverage from a research standpoint?
Okay, so you raise a point that I'm going to take a minute of your time to explain it.
Just one, though.
Sorry. But trading in our top 500,000 names, it's really liquid. It's good. You can get execution. As you go further down the spectrum of public companies, trading is fairly thin
and volatile.
And in fact, making a trade in any size that's meaningful can have an impact on the price. Well, if you know that going in, that it might be difficult to go out, you're less likely to go in. And that's sort of the issue. And we're looking at ways to deal with what we refer to as thinly traded stocks. And one of the questions we have is our architecture with a lot of exchanges and even more trading venues that seems to work really well for those top names, is that the right architecture for the more thinly traded names?
Thank you. And then, so if I could put you in the seat of a CFO, a private company CEO, fast-growing business, pick your name, doesn't matter, right? Call it Slack pre-IPO. I would argue that if you're a CFO thinking about, okay, where do I want to raise my next 100 million? I either do it in the private markets or the public markets. If I do it in the private market, I'm shooting out 10 emails to my favorite investors, having a couple meetings, putting a slide deck together. You can probably go through that whole process in a couple months if you're that kind of business. Do the same thing on the public side. You want to go IPO? You're going to spend millions of dollars hiring staff, attorneys, putting a book together, shopping it, doing the roadshow bit. In that world, using that analogy, what should we be thinking about to kind of close the disparity? Because I would argue, and from my conversations I've heard, that kind of difference is one of the things that would keep a company private as opposed to public.
You articulated it very well. Let's look at who's making those decisions. It's the people who own those private companies and are running those private companies, and they want to grow them, and they're saying, where's the best place for me to get growth capital that allows me to pursue my vision for growing this company? And as we look at our public market rules, we need disclosure, we need fairness, we need good financial statements, we need all of those things, but are we doing more that makes that choice? I'm going to stay private because I'm worried that I'm going to lose my ability to pursue my vision in the way I want.
And then Main Street investors can't participate.
Main Street investors can't. And they get in there. The great thing about our public markets is the Main Street investors, they sit side by side.
Yep. And then my final piece, I want to go to crypto, which we've talked about a lot. I think Mr. Davidson hit it well. Blockchain is here. It's a technology. It's being developed. But now folks are moving to Singapore, Switzerland, the UK because of the clarity. And my concern is what I heard earlier was until we see it operate, we don't know whether it's a security or not. When I talk to the companies, what they would say is, well, we're not going to operate until we know whether we're going to be dinged as a security or not. So we have this chicken and egg piece. They move overseas, and they say, well, we'll build our businesses over here. Once the U.S. figures it out, we'll consider coming back. That I find concerning, and I guess I would ask, when can we expect more guidance? We've only had 2 no-action letters. When can we expect something a little bit more concrete from the SEC? Or what are you doing to get there so that we can just provide some certainty here?
Yeah, one of the more difficult things about this, though, is each project is a bit different.
They are, but your job is to get this right.
And we are, believe me, we have people who are focused on doing this, like Commissioner Peirce noted.
Yeah.
Utility tokens that are truly for use and get rid of the frictions needed with moving around. I may have too much computing power. You may have too little, and I'm able to shift it to you with a token in a very great, fabulous. But if you're trying to build a server farm with those tokens and give people the return, that's a.
Thank you. I know it's hard. With my final second, I just want to encourage you to go faster. We need it. Thank you.
Thanks.
The gentleman from California, Mr. Vargas, is recognized for 5 minutes.
Thank you very much, Madam Chair, and I want to thank the commissioners for being here and for the work that you do. Thank you very much. It's very important. As you stated in your testimony, the first responsibility in the SEC's mission is to protect investors. The Securities Act of 1933, which preceded and set the groundwork for the legislation that would create the SEC, requires companies to disclose all material facts about securities so that investors can make fully informed investment and voting decisions. Recently, it has been made clear that many investors view environmental, social, and governance, or ESG matters, as important for evaluating reputational risk and financial performance. Commissioners Jackson and Commissioners Lee, you both issued a joint statement on the SEC's recent proposed changes to Regs SK. You applauded the Commission for adding disclosure on the critical topic of human capital. However, you both raised concerns that the proposed approach gives company executives discretion over what they tell investors. You also highlight that the proposal does not seek comment on whether to include the topic of climate risk. Can you please explain these issues and why they are problematic for investors? Commissioner Lee, why don't you go ahead and go first?
Thank you, and thank you for your attention to that matter. It's very clear, we've heard from those managing hundreds of millions and trillions of dollars worth of investments, that these are important parameters that they need in order to make investment decisions based on the long-term sustainability and value-building efforts inside of a company. So I did regard, there were certainly a lot of good points raised in that proposal, which I agreed with, and I do appreciate the inclusion of human capital. I think comparability is extremely important for investors. And that's why Commissioner Jackson and I both thought it was important to at least put that out there to get some comments on, because it won't help if each individual executive inside a company is making their own decision about what is material. It makes it very difficult for investors to compare. You have to balance that, but I am concerned about a shift that goes strictly to principles. And I did regard also the issuance of that proposal as a missed opportunity to also isolate and highlight what we've been hearing from investors for quite some time now, that they need and want more about climate risk.
Thank you. Would you like to add anything to that, Commissioner Jackson?
Well, sure, Congressman. Commissioner Lee's got this one right. But at a broader level, we could just ask the following question. When it comes to figuring out what's material, who decides? And I think the law and the history of our markets is very clear. Investors do. Investors decide what's important to investors. That's why Commissioner Lee and I issued a statement wondering why we didn't go further in this area, given that it's so clear that investors care about these risks.
Thank you. I know you're not going to comment about specific bills, but I do have one on that. But I would like to ask about diversity, the issues of diversity. Again, I think that's something very important. And we have, in fact, seen that it is a valuable asset to a company. Could you like to comment on that, Commissioner Lee?
Yes, I wholeheartedly agree that it's an important and valuable asset for companies. And I think, more disclosure on that, both at the board level and with respect to the workforce, would be valuable to investors, because I think it's quite clear that that helps build value inside companies. So I strongly support that.
Commissioner Jackson?
Thank you, Congressman. I absolutely agree that we need to do more in this area. Before I joined the SEC, I was a member of a group called the 30% Coalition, which states as its goal to make sure 30% of board seats in the United States are held by women. And, sir, I think it's a scandal that we haven't reached that goal yet. I agree with Commissioner Lee that diversity is enormously valuable to our companies, and that we should do more to encourage diversity at all levels throughout public companies.
Thank you. And again, with respect to ESG, Chairman, why don't you handle the issue of the committee recommending or not recommending the mandatory disclosure of corporate political spending? I think that Commissioner Jackson gave a quite impassioned speech at the beginning about money that oftentimes is spent in significant amount that ultimately the investor doesn't know where it's going, and in fact might be contrary to the investor's opinion. Could you comment on that?
I'm sorry,
I think yeah, did you hear, maybe Mr. Commissioner Jackson, well, I got only 20 seconds left. Why don't you help him? I think he may not have heard the question.
It may be, Congressman, that what you have in mind is my description earlier for proposals to require companies to disclose their spending on politics when
That's right.
they use shareholder
Oh,
money.
I'm sorry, I thought you said, where we stand today is if that is material, it's required to be disclosed. We also have had a fair amount of shareholder engagement on individual.
Okay, my time has expired, but I guess you're not saying that that is material.
No, I'm not saying it. If it is, it should be disclosed.
No, not if it is. You're not saying that it is.
I'm not making a conclusion, no.
Gentleman from Tennessee, Mr. Rose, is recognized for 5 minutes.
Thank you, Chairwoman Waters. I want to begin today by reiterating my colleague, Mr. Lukemeier's concerns about the implementation of current expected credit loss and encourage you, Chairman Clayton, on that issue. As I was back home in the 6th District in recent weeks and visiting with community bankers, I heard nearly uniformly from them concern about the implementation of CECL and, again, a uniform refrain that they are ill-equipped to adequately forecast future economic activity and that the end result of the current policy would be to increase the cost of credit for early-stage borrowers, startup businesses, and small borrowers. And so I encourage you to continue to keep up the pressure on the FASB folks about that, and I think it would be very smart if we studied that question a little bit more. I want to applaud the Commission's efforts under your leadership, Chairman Clayton, to meet with the public outside Washington, D.C., hosting events like the historic Investor Town Hall in Atlanta in June 2018 provide a unique forum for our constituents to engage with the Commission. As a new member of Congress, I can tell you that one thing I have learned is that nothing beats getting out of Washington and meeting with my constituents back home in the 6th District of Tennessee. I hope you will continue these efforts as you work to better serve Main Street investors. Chairman Clayton, I'd like to drill down a little bit on the Office of the Advocate for Small Business Capital Formation, or OASB. In my district, there are 3 economically distressed counties in fiscal year 2020, down from 4 in fiscal year 2019. Small businesses are often the engines of growth in areas like the 6th District. What is this office doing today to help small businesses in rural areas?
Well, I hope a number of things, because it is a number of things that we need to do to foster small business capital. Navigating our regulations, we assist with that. But what is it that makes a small business grow? You need access to capital. You need access to human beings who can help you grow. And you need the expertise from lawyers and accountants and others who facilitate that type of engagement. And what we've seen is that areas where you have a critical mass of that, entrepreneurship flourishes much more quickly. So one of the things we're doing is we're trying to facilitate that type of engagement on a local basis. Look, if you look at the successful places, they have all of those elements. They have the professionals, they have the capital, they have the expertise. And one thing that's often missing is if you have multiple small businesses in different areas, they feed off each other. There's a virtuous cycle to it. We're trying to help foster those kinds of ecosystems.
I was proud to join with several of my colleagues here today to pass H.R. 2409, which added rural small businesses to the mission of the Office of the Advocate for Small Business Capital Formation. Chairman Clayton, is there anything more Congress should be doing to empower the SEC to be more proactive in these underserved areas?
So here's what I'll say. We're getting off the ground here. Martha Miller's doing a terrific job leading that office. If we keep doing a good job, we're always asking for money, but give us some more money to do a better job and build out that office.
Commissioner Roisman, you noted in a speech this past April that there are fewer opportunities for retail investors to invest in companies in their early stages of growth and more generally in smaller IPOs, citing barriers to small business capital formation that the Commission should address. In your view, what should the Commission be doing to address this issue?
Thank you for that question and for touching upon this important issue. I think we're always looking to see whether the current rules we have help foster more capital formation and promote the three-part mission of the SEC. I think we can do some things to help address some of the concerns people have who are smaller companies and give them certainty about what their requirements are going to be in terms of what they need to do to be a public company. I also think some of the discussions earlier today are really helpful. I mean, capital formation is inextricably linked to secondary market trading. So when you're a small company, it's harder to succeed in terms of having really good secondary market liquidity. That's something we should look at.
Thank you, and Chairwoman Waters, I yield back.
Thank you. The gentlewoman from Massachusetts, Ms. Presley, is recognized for 5 minutes.
Thank you, Madam Chair, for your leadership on issues of accountability and oversight, and thank you to the commissioners for joining us here today. I want to jump right into an issue that has led to a great outcry and phone calls to my office from investment firms and religious organizations throughout my district, Massachusetts 7th. Chairman Clayton, yes or no, are you familiar with the history of the shareholder resolution?
I'm sorry, the shareholder.
The shareholder resolution, specifically the first shareholder resolution filed on a social issue?
I need some help here.
Okay. So in 1971, Episcopal Church presiding Bishop John Hines presented to the Board of General Motors a shareholder resolution filed by the church requesting that the company stop doing business in South Africa. Many members serving in Congress, including our very own chairwoman here, were on the front lines of this fight, using every financial tool to force behavioral change on the part of corporations and, by extension, society at large. My colleagues on the other side of the aisle often point to the role of the private sector in addressing any number of social and economic issues. Climate change, human rights, labor standards, all pressing issues. Issues that everyday investors in public companies can currently inform. Right now, all that is required to submit a shareholder resolution or to resubmit one on issues like these is to own $2,000 in stocks. Your commission wants to change that threshold. Some of our Republican colleagues have supported legislation that will require a 1% threshold to file a resolution. In other words, to file a resolution at ExxonMobil, which has a market capitalization of $347 billion, an investor would need to own over $3 billion in stock. Chairman Clayton, yes or no, do you think it's responsible to require an investor to own over $3 billion in shares just to file a simple resolution?
I'm going to give you an answer you like, but not a yes or no answer. That number is way too high as a threshold, as a responsible threshold for engagement.
And so what will the new threshold be?
We're working on it, but what will the new threshold be? In my ideal world, we can't live in an ideal world, but in my ideal world, it would be a threshold that allows access for people who are long-term investors in a company and have a meaningful stake, but a meaningful stake at a personal level, but eliminates some of the, what I would say is, I don't like it that 25 or 30% of the proposals that we see are from a handful of people. I want people to have engagement, and I'm
So I'm just wondering who you've heard from.
I'm seeing if we can improve this.
Okay, I'm just wondering again what informed this. So I know who I've heard from in my district, the Massachusetts 7th. I've heard from religious investors like Sisters of St. Joseph's. I've heard from AFL-CIO. I've heard from Sisters of Notre Dame, the Unitarian Universalist denominations, the Episcopal Diocese of Massachusetts, First Parish, Cambridge, investment firms like Loring, Wolcott, Coolidge, Boston Trust Walden, and Trillium Asset Management, all who are opposed to any changes to this process. So who did you hear from, other than the Chamber and the National Association of Manufacturers and the Business Roundtable? Where is this coming from? What's the genesis?
We've heard from a number of companies. And look, on whether those entities will be able to make proposals, I'm only speaking for myself. My colleagues can have their comments. I'm not looking to keep those people from being able to make proposals. We are looking, I will say we are looking at the resubmission thresholds. I'm looking at the resubmission thresholds more closely than the initial thresholds. And one of the reasons is those resubmission thresholds, they were set, like I said a few moments ago, at a time when the mails were how we communicated. People are fairly aware of what's being voted on.
I'm just going to claim my time because the clock is, no, I appreciate that. It's just that, you know, we are facing an unprecedented crisis, and chief among them being climate change. And we need every tool and all tools available to us in this fight. And the SEC's mission is to first and foremost protect investors. So I urge you to reconsider any changes to the shareholder resolution process. Thank you, and I yield.
Thank you. The gentleman from Wisconsin, Mr. Stahl, is recognized for 5 minutes.
Thank you, Madam Chair. Commissioner Roisman, I commend you for your work, particularly on proxy advisors. Proxy advisor firms are also providing sometimes consulting firms to some of the publicly traded companies that they're reviewing and analyzing. I just want to get a flavor of the committee, if that's a potential conflict that should be examined as part of this process. Commissioner Lee?
Yes, well, so in the first place, I will say that both of the two largest proxy advisors, I believe they do make such disclosures. I think it's important that we do have transparency around conflicts, and I think that they are have been for quite some time disclosing those conflicts.
Thank you. Commissioner Jackson?
My answer to your question, sir, is yes. These conflicts are serious, deserve scrutiny from the marketplace more generally, and certainly from securities regulators.
Thank you. Chairman Clayton?
Yes, I believe in disclosure of material conflicts across the board.
Commissioner Peirce?
Yes, I think that's what our guidance was trying to get at, that investment advisors need to think about those conflicts.
I think they all said it well.
I appreciate, Commissioner Roisman, you taking this topic on and look forward to seeing the results of some of your work on this. I want to go back earlier in this hearing. There was a brief discussion about stock buybacks. And to me, that's really an efficiency of capital allocation conversation. And so I think the question comes down as to what is the role of the SEC in putting in place rules in governing management's decision on the efficient capital allocation as it relates to across the board on that, if that's really the role of the SEC or if that's the role of private management to make efficient capital allocation decisions. Chairman Clayton, could you comment as to how you approach that analysis?
Well, I think you framed the question pretty well. When a board of directors is thinking about whether to invest in a particular item, buy another company, pay a dividend, or return capital to shareholders through a stock buyback, that's not within our purview to regulate those decisions. If they do decide to do a buyback, what is within our purview is whether they do so in a way that does not affect the market in an impermissible way, that doesn't, as we say, create manipulation. And our Rule 10b-18 is a safe harbor that says if you comply with this rule, absent intent or other circumstances, you're not going to be deemed to have manipulated the price of the stock.
Thank you. In your testimony previously, you wrote that you're motivated by the fact that tens of millions of Americans are invested in our capital markets and have to make personal investment decisions. I think it's an important detail to always keep in mind the number of Americans that are invested either individually through their 401k, through their pension plan, in United States publicly traded securities in the critical work that you're doing. Just recently, we were having a conversation, in particular as it relates to resubmission thresholds. Want to open that back up to you, Chairman Clayton, as we think about this and the ability for management to stay focused on innovation and growth, not be distracted by kind of repeated. And we look at those thresholds. Can you kind of just take another second to walk through your analysis as to what that resubmission threshold is and the impact that can have on management when there's repeat submissions?
I mean, look, you have engagement. Hopefully engagement with shareholders leads to more than just here's a proposal, do this. It leads to tell us about this particular issue, how you can improve, and have a more nuanced conversation. But sometimes the ballot box is important. And then the question is, it's been put to shareholders. It has not passed. How many times and what level do you have to get to continue to put it to shareholders? And like I said, that has not been examined, I think, since, I'll turn to Commissioner Roisman, since the 50s. And one of the issues there was, look, we're using the mails. Shareholders should be informed about what's been in front of management, how long. That information is disseminated very quickly today. There are proxy advisory firms. You can get that kind of information, and the question is, do we need to re-examine that or not?
I appreciate your work. I think there is a real opportunity to re-examine that, to allow management to stay focused on actually operating the company rather than on some of these distracting and repeat proposals. So I appreciate your work on that. I appreciate you all being here, and I yield back the balance of my time.
Thank you. The gentleman from New Jersey, Mr. Gottheimer, is recognized for 5 minutes.
Thank you, Madam Chairwoman, and thank you all, to all the commissioners, for being here today. Chairman Clayton, millions of seniors across the country, including my own mother, have been the victims of financial scams, and they have been cheated out of their rightful retirements. Do you agree that we should be doing everything possible to prevent our seniors from being robbed of their life savings?
Yes.
Thank you. Chairman, are you familiar with the Senior Security Act, and have you read the bill?
Is this a pending bill?
No, it's a bill that passed out of the House of Representatives.
Yeah.
I can give you a little bit.
There's a couple of bills with similar types. Give me the.
Yeah, sure. It's a bipartisan bill that I introduced with my good friend, Mr. Hollingsworth, that would create a senior investor task force at the SEC, specifically designed to stop financial predators and hucksters from scamming seniors out of their savings.
I know this one.
It passed out of the House, overwhelmingly bipartisan, 392 to 20. So anyway, that's the bill. In my work to pass the bill into law now, I understand that you may have said you don't have time for the Senior Investor Task Force to report to you, which the bill would establish. You know if that's true? Did you say that you don't have time for the Senior Investor Task Force to report to you?
That sounds crazy.
I agree. Yeah. That's what I heard, so I just wanted to check.
Don't believe everything you hear.
So you can commit that you'd be happy to have the Senior Investor Task Force report to you, like other task force do?
Yeah, sure.
Excellent. That will really help, I think, in getting this legislation passed. As you probably know,
look, our door's open. You know, people have. Yeah, go ahead. Sorry.
No, please. Yeah.
No, just happy. That kind of engagement's important to our work.
Thank you, Chairman. I think it's very important that I report to you. I mean, as you probably know, and according to a report from the Senate Special Committee on Aging released this year, $3 billion, seniors are scammed $3 billion every year, from financial scams and those who abuse seniors and prey on them, all these hucksters. So it's a real issue, and I know it affects so many Americans. According to a survey from the Investor Protection Trust, approximately 7 million Americans have reported being victims of exploitation. Not only that, but 1 in every 24 cases of elder exploitation actually gets reported. So it's obviously a very important issue.
Yeah. Now, and we hosted folks from the Department of Justice and others about a year ago on this issue, and unfortunately, some of this is people they know well, and some of it is driven by things like opioid dependency, where people are stealing from seniors. We're doing things, but we need to recognize these risks.
I think this legislation will really, which again is very bipartisan, will really go a long way in helping in that effort. I don't know if any of your colleagues, Commissioner Jackson, I don't know if you want to add to that.
Congressman, I agree with the chairman. Let me add one more thing. I think your focus and leadership on the issue is enormously important. And I have watched as the chairman and his very able enforcement co-directors have worked through many of these cases. We see these victims, Congressman, you are right, that we need to do all we can to protect them. And I doubt there's any disagreement among us on that subject.
Excellent. Well, I'm not going to stop until we get this bill signed into law, and hopefully we can work together to make sure we get there and continue to help seniors save their hard-earned money for retirement. So obviously they can stay in Jersey, where I live in the 5th District of Jersey, and stay in their homes and enjoy their lives with their kids and their grandkids, which, as you know, those who are often scammed unfortunately lose their homes and have to decide if they can pay for their medicine. So it's a real issue. I don't know if any other commissioners want to comment on this issue. Commissioner?
I think we're all committed to doing what we can to protect older investors, and the problems associated with that only become more intense as the years go by, as people are living longer and as capacity issues come up. So there are a lot of complicated issues, and I think a task force to think about this could be helpful to us as we think about these issues as well.
Excellent. Well, I think, and hopefully we can work together to encourage the Senate to pass and to vote on the Senior Security Act and get this into law. I know Mr. Hollingsworth and I would, as many members of the committee, would be very grateful. Thank you so much for your time, and I yield back, Madam Chairwoman.
Thank you. The gentleman from Michigan, Mr. Huizinga, is recognized for 5 minutes.
Thank you, Madam Chair, and my apologies as ranking member of the committee that oversees you. I was not here at the beginning for your opening statements, but I had a constituent whose name is Sawyer. Sawyer's 10. And last year, she put together 25,000 care packages for members of the military, and she was asked to lay the wreath at the Tomb of the Unknown Soldier this morning. And I was honored to be asked by her to join her. So I love you all and appreciate what you're doing, but Sawyer's work took some preeminence this morning, so forgive me for that. But I want to quickly move through 4 items, if possible: ESG standards, Reg BI, money market funds, and, if possible, Advisors Act. Look, it's been well established that current law says shareholders can have their voice heard and their directives followed through this system of bringing resolutions to boards that has been of some discussion and debate. It begs the questions if investors have moved these ESG standards to the top of their list, as Commissioner Jackson had indicated. Why aren't more companies adopting these standards formally? It's because their shareholders have voted them down. And I think it is very important that you look at those resubmissions for not just this issue, but for others. And Commissioner Peirce, you've done a lot of work on this, and I'm curious if the SEC writ large has any, quote, expertise in environmental or social goals such as that, and in your view, should we be developing mandatory disclosures based on that expertise? Real quickly.
Mandatory standards, I think, in this area just are not, they don't work.
And Mary Jo White, the Obama appointed chair, had made that same observation regarding conflict minerals, and under this particular legislation that the committee has been looking at, these ESG metrics would be viewed or deemed de facto material. That seems problematic.
I agree. I mean, companies have been thinking about a lot of the issues that fall within the ESG umbrella for a long time, but they think about it, and we expect them to think about it through the materiality lens. Is it going to be material to the financial long-term value of the company? That's how I view these things, and I think that's how we should view all issues that affect companies.
So lots of discussion about what is material, and I appreciate that. Reg BI, Reg Best Interest. I understand, Chairman, there's been a lot of criticism about the regulation, and in your July 8th speech, you state much of the criticism is focused broadly on the extent of the investor protection fiduciary interpretation is, quote, false, misleading, misguided, and unfortunately, in some cases, is simply policy preferences disguised as legal critiques, end quote. Would you like to address those criticisms and set the record straight on Reg BI right now?
Look, I would refer for a detailed discussion, and I think a very thorough one. I would refer to my speech, but let me just talk about Reg BI.
Well, one of my colleagues earlier had said that you watered down the fiduciary duty as you put this package forward. Is that true?
No, it's not true.
Okay. Well, go ahead. I've got a moment.
Look, so on regulation best interest and the obligations broker-dealers owe their retail clients, we have an overarching obligation that they can't put their interests ahead of the clients. We've made a clear disclosure obligation where you have to say how you make your money. We have a clear care obligation where you have to know your client and tailor the product recommendation to your client's needs, including where they may be in their life cycle. Then we have a conflict mitigation obligation that's directly in the rule. And finally, we have a policies and procedures obligation, because words are good, but unless you have an ability to test them against procedures, it's very difficult to enforce them. So that package was developed in combination with our Division of Investment Management, our Division of Inspections, and our Enforcement Division to give real teeth to this rule.
In my remaining minute, back in 2017, when I chaired that particular subcommittee and Congresswoman Maloney was a ranking member, we wrote to you on regulations the SEC implemented for money market funds, and you had written in your response, I say, quote, the MMF reforms were not fully implemented until October of 2016, and I'm concerned that making major changes at this time would be disruptive to the short-term funding markets, close quote. I agree with you, and so as Federal Chairman Jerome Powell testifying before this committee, Secretary Mnuchin has identified some of those same issues. Do you still believe major changes would be needlessly disruptive, and is there anything else you'd like to add on that?
I don't know that I want to say needlessly disruptive, but I think we should look at whether short-term funding in the space that it moved out of, which is it moved from kind of private to govy, has indeed been impaired, and if it has, we should think about what we should do about that.
I appreciate the opportunity, and I'll yield back.
Thank you. The gentlewoman from Michigan, Mrs. Tlaib, is recognized for 5 minutes.
Thank you, Madam Chair. Detroit's housing crisis, I talk about it in this committee a tremendous amount of time because a lot of it is interconnected with the work that we do here. But as many of you may or may not know, the crisis is very real in my district, in the 13th Congressional District. According to 2018 report from the Urban Institute, Black home ownership rates in Michigan decreased from 51% in 2000 to 40% in 2016. Currently, the wait list for affordable housing is 6 months to a year. Chairman Clayton, you stated that, quote, the Opportunity Zone program has the potential to encourage investment and economic development in many areas across the country that are in need of capital. I would consider my district one of those that are in need of economic development, so I would like to talk about that a little bit. And I don't know if Commissioner Jackson, if you could help me with this. So according to SEC, such qualified opportunity zones funds must comply with all applicable regulations of the SEC and the securities regulators in the states where they are doing business. Can you elaborate what that really means?
Can you say a little more, Congresswoman, about?
Yeah, so on the site it says, on the SEC site, it said that they have to be regulated under SEC and the security regulators in their states in doing business. What does that really mean for opportunity zones? Those applying. Oh, Chairman, go ahead.
Sorry.
You were the one quoted to say how great it is.
That was something that we saw opportunity zones. People are raising money for them, and we wanted to remind them that you've got to follow the investor protection rules that we in the states have. So we put this out to say when you raise capital, be mindful of those rules and the disclosures that they.
So Chairman, does SEC have the authority to define and clarify opportunity zone funds that were established and expanded in the 2017 tax law?
We do not have direct authority over the size or those types of things. What we do have authority over is how they raise their money for those projects. So when they go to investors and say, hey, we want to raise money for this project, it's an opportunity zone. Are they doing it in a compliant way?
So, and this is yes or no to any commissioners, do any of you any knowledge of developers that qualify under opportunity zones are required to produce a significant number of jobs? Do you know of any, are they required to, do you know if they're required to provide, like if these are the number of jobs that we're going to provide with the opportunity zones?
I can't say that I'm familiar with that.
Not to my knowledge, Congresswoman.
Chairman?
I'm not aware of that.
I don't know how that works.
So are developers who benefit from the opportunity zones required to help with poverty reduction in return of their tax break?
Again, Congresswoman, not to my knowledge.
None of you? Okay. I have an issue with opportunity zones, and this seems oddly familiar because in 1980s, enterprise zones, which the GAO ultimately concluded had no significant difference in economic growth or job creation in surrounding areas, wealthy real estate developers made money from enterprise zones, but communities were not actually prospering because of it. On that note, I want to submit for the record, Madam Chair, a New York Times article that reported that Donald Trump and his family and advisors will benefit tremendously from the Opportunity Zone.
Without objection, such
And
as
Chairman Clayton, so I was taken aback by the statement that you supported opportunity zones and see it as an opportunity. You went on to say a lot of things, great things about it. So Wayne County is experiencing rapid gentrification. It's in my district where lower income communities are pushed out while tax dollars are going to wealthy developers and corporations to build shiny new stadiums or luxury condos they can't afford. I am, in a flow and then I stop. The SEC announced 2 weeks ago, where am I? I'm sorry. So my question is, then why would you say the statement that you said in regards to opportunity zones as an opportunity for economic development? Because it is a tax break, right?
Well, actually, one of the reasons I put the statement out was, hey, comply with the law. Hey, capital formation is good. But if you look in the statement, there's also something there that says, our regulations make it hard for people who live in those jurisdictions to actually invest alongside the people who are investing in these opportunity zones. To me, that's an issue. We want to help people make that opportunity available to the people who live in the zones in which they're investing. And it's, there are ways to do that.
Yeah, I think if you're going to talk about it in the future, to make it much more clearer, because it sounds like you're just supporting it without any kind of accountability. With the Indians, like follow the law, but in many ways we're promoting it as some sort of way to deal with those other issues that I think.
But I recognize the issue, and I wanted to say, hey, let's find a way to let people in that community participate.
Thank you. Thank you. Thank you, Madam Chair.
Thank you. The gentleman from Texas, Mr. Gooden, is recognized for 5 minutes.
Thank you, Madam Chair. As you all know, the individual investor, they don't have shares in stock like they used to. Big firms, big investors have the bulk of these shares. And they rely a lot on these proxy investors. A few questionings ago, you all said you supported transparency for these proxy advisory firms. Do you support further efforts to increase transparency among how their analyses are produced, about how they come to the conclusions that they come to? I know a recent vote, I think it passed 3-2, worked on some of that, but are there any plans in the near future to increase transparency among these proxy advisory firms?
Congressman, it's a good question. I won't speak to the plans going forward. I want to take a moment to acknowledge Commissioner Roisman's leadership in this area. It's been enormously effective and important, and he's engaged across with all 5 of us, really, to help us get this right. Sir, I think there's already some transparency of the conflict you're describing, but I want to go back to what I said earlier. Anytime a business model under our jurisdiction has a conflict, we need to get information out to the marketplace about that conflict. And I support that here as I do in other contexts.
So I appreciate the question, and I appreciate the comments from my fellow commissioners, Commissioner Jackson. What I'll say is, I think we've done an important first step, what we did in August. And part of it was reaffirming what the Commission's interpretation of the law is with respect to the use of proxy advisory firms by asset managers and investment advisors. And it always comes back
Could you pull the...
I'm sorry. And what it comes back to is ensuring that if they're responsible for undertaking the vote on behalf of retail investors, they've got to do what's in the client's best interest. They have to vote. And part of that is, I think, understanding what those conflicts are and whether those conflicts can be overcome or addressed or mitigated.
I think one of the concerns, and I represent the Dallas area, we have a lot of companies based there, and I've heard from leaders of many of those companies that these firms, they just put out their analysis and they often don't get any input. Some of the things that I've heard that would be helpful is they perhaps maybe get a phone call and say, hey, this is what we're about to put out. Do you agree with this? Maybe they're not going to change it, but perhaps they're missing something. Another thing I think that would be helpful in your rulemaking process is giving a company an opportunity to respond to what is being put out about them and have it attached to whatever this analysis is without edits. I think we've gotten to the point where these proxy advisory firms have become such a big part of daily business. I've talked to CEOs who say, we feel like we answer to these firms. One of them is called is ISS, and they, not jokingly, call it ISIS. And that's just a common term that these leaders of these companies use to refer to this particular company because they feel like, do we have an echo in the room? They feel like they are beholden to these proxy advisory firms. And it also kind of goes hand in hand with the shareholder resolution process. We've gotten some of these radical shareholder proposals that these proxy advisory firms have such great influence over. And so I want to encourage you to work on the rulemaking procedures. I know you said that $3 billion is obviously too large. I agree with that. But companies that are spending so much time and dollars fighting resolutions which don't help the company or don't help investors, don't help the employees. I saw a fact here that 56% of all shareholder proposals in 2017 were related to social issues with little connection to company performance. And so much of this, when these proxy advisors are encouraging a vote one way or the other, I think it's important that we know where they're coming from and that these conflicts of interests are disclosed, and I would ask that you all work on that, please. And I yield back.
Thank you. The gentlewoman from California, Ms. Porter, is recognized for 5 minutes.
Hello, Chairman Clayton. You've spoken very highly about the importance of disclosure to maintaining healthy markets. And during a December Investor Advisory Committee meeting, you said, quote, disclosure is at the heart of our country's and the SEC's approach to both capital formation and secondary liquidity, quote. So disclosure is at the heart of the SEC's approach. You made that statement in the context of speaking about ESG, or environmental, social, and governance disclosures. Do you generally believe that ESG disclosures are a useful tool that provides information for investors who consider or want the option to consider using that information in investing their money?
I believe that there are disclosures in each of those categories that, depending on the circumstances, can be quite meaningful to investors.
Thank you. Commissioner Peirce, you've compared ESG disclosures to scarlet letters, in the vein of the high school novel, The Scarlet Letter, in which an unwed pregnant woman named Hester is marked with a red letter A for adulteress. You said, and I quote, as with the Scarlet A, the ESG letters oversimplify complicated facts. Do you remember making that comparison between ESG disclosures and the Scarlet Letter?
I do.
You actually said, and this is colorful, quote, we ought to be wary of shrill cries from a crowd of self-appointed, self-righteous authorities, even when all they are crying for is a label, end quote. So in your opinion, those who support ESG disclosures, the requirement that companies give investors information about, for instance, their environmental impact or their gender diversity, those people are shrill, self-appointed, and self-righteous. Commissioner Peirce, would you consider Commissioner Clayton to be shrill?
Not at all.
Do you consider Commissioner Jackson to be self-righteous?
Not at all.
Do you consider Commissioner Roisman to be self-appointed?
Not at all. I'm not sure.
Commissioner Clayton, do you consider yourself to be shrill or self-righteous?
I try not to be.
Would you call investors who request ESG disclosures to be shrill or self-righteous?
So I don't like to put a blanket on investors as a group, but I believe that people who engage on this, they're no good. They care.
They presumably want the information because they believe
they care
that it's maybe useful to them. Commissioner Clayton, Chairman Clayton, do you believe the letters ESG should actually stand for enabling shareholder graft, as Commissioner Peirce said during a recent speech at a think tank? Graft, of course, being the advantage one gets from corruption.
No.
Thank you. Commissioner Peirce, you spoke in your opening statement about regulatory humility, that the SEC should be sensitive to the learning it can do from other sources. You mentioned advisory committees as a valid source of information. Does your commitment to regulatory humility extend to the general public's comments as investors?
I welcome comments from the general public. I think they're very valuable as we think about how to regulate.
So the 1.2 million comments received in support of the disclosure of political spending by corporations, do you have enough regulatory humility to stand with the public who's requested those disclosures? Or do you think you're smarter than those million-plus people?
Corporate political spending is not on our agenda now. I believe there's a legislative ban on us considering that topic.
Moving to Mr. Jackson, are corporations required to disclose executive compensation?
Yes.
Why?
Because there's a conflict between the interest of the investors and the insiders when it comes to how much the insiders are paid.
So why is there not the same conflict between investors and executives when it comes to political spending?
Congresswoman, I believe there is, because insiders benefit from political spending that they favor.
How?
They get the ability to use someone else's money to support political causes that they prefer as opposed to the investors' preferences.
For example, a political cause like lower taxes on the wealthiest Americans, which may not in fact benefit the Main Street investors who are at much lower income levels.
That's certainly one possible example.
So we require companies to disclose executive pay because we're worried that executives may overpay themselves, and that same misalignment of interest applies for corporate spending.
That's my view, Congresswoman, yes.
Thank you. I yield back.
Thank you. Mr. McAdams is recognized for 5 minutes. The gentleman from Utah.
Madam Chair, parliamentary inquiry. I was informed that there was a 1:30 hard stop that had been negotiated. What is the status of that?
Yes, we had a 5-minute break, and so we're going to make up with Mr. McAdams, and then we will excuse our witnesses for today. Thank you very much.
Thank you, Madam Chair. Thank you, Chair Clayton and fellow commissioners for being here today. The work of the SEC is vital to ensuring our capital markets remain healthy and can promote job growth and economic opportunity. I used to teach as an adjunct professor securities regulation some 10, 15 years ago, and I would teach my students that our capital markets only work to the extent that investors have faith that bad actors cannot profit off of wrongdoing. And so that's where I want to start today. Chair Clayton, as you know, 2 years ago, the Supreme Court ruled in Kokesh versus the SEC that the SEC's disgorgement authority was a penalty and thus subject to a 5-year statute of limitations. The court further hinted that the SEC may not have this authority at all. As a result, the SEC can only bring enforcement actions involving disgorgement within 5 years of the violation, even if the SEC had no knowledge or possible way of knowing about the securities violation. And the immediate result of this case was that Charles Kokesh was able to keep $30 million in ill-gotten gains. But I want to go broader than just the individual case at hand. Can you talk briefly about the effects of the Kokesh ruling on both investors and the SEC?
So I think, look, it's adverse for investors who were defrauded and adverse for the markets generally. You shouldn't be able to have somebody who conceals a fraud well get to keep the money if they're really good at concealing the fraud. That doesn't make sense.
That's right. Bad actors face fewer consequences. Investors are less protected. Estimate of disgorged funds that were unable to be recovered, I think, and probably more staff time and resources to fighting lawsuits from bad actors. Mr. Chairman, as you know, I, along with my Republican colleague Bill Huizenga, I think Mr. Huizenga is here today, I introduced the Bipartisan Investor Protection and Capital Markets Fairness Act. And last week, this committee approved that legislation on a broad bipartisan basis. The bill would specifically authorize the SEC to seek disgorgement and injunctions against bad actors and give the SEC up to 14 years to pursue these actions. So do you support this legislation, and do you believe that it would effectively address the negative effects of the Kokesh decision that we've discussed?
As I mentioned in my opening, my colleagues and I, the members of the Enforcement Division, we thank you for your attention to this, and we want to see a fix to the Kokesh issue move forward here and in the Senate. I understand there's debate about the contours, but yeah. Let's get this fixed.
Yeah. And generally speaking, we very much appreciate my staff and appreciate working with the SEC to try and bring this fix and to bring forward a legislation that can garner bipartisan support and seek to address this, and understand that, like any piece of legislation, there's a path moving forward, and we'll ultimately have to reach agreement in a bicameral fashion as well. Generally speaking, do you see that legislation as a positive step forward to granting the Commission the authority it needs to enforce?
I do.
How important, tell me, a level of priority, how important is it to you that Congress address the Kokesh decision to ensure that our capital markets are fair for investors?
Okay, it's a focus of all of ours that when there's wrongdoing, not only do we act quickly, do we act decisively, but we get people their money back. And these types of frauds, Ponzi schemes, they're basically taking money right out of the pockets of ordinary investors. We talked about Stanford earlier, those types of things. It's important to the integrity, and it's just important to our citizens that we can get their money back.
Thank you, and we appreciate your willingness to work with us on that and to move forward legislation. Are there particular types of cases in which investors are vulnerable without a fix to this court ruling?
Yeah, we had some discussion of Stanford earlier. It is those well-hidden schemes, particularly in our private markets, the hey, I have the secret sauce, don't tell anybody type of situation, or, we're all friends here type of situation, that they're particularly vulnerable to the issue that was raised by the Supreme Court decision in Kokesh.
Thank you. And Mr. Chairman, some have argued against this legislation, saying that 5 years is more than sufficient for the SEC, and that if given more time, the SEC will just pursue old or stale claims. What would your response be to that assertion?
Look, I think in the area that I just described, Stanford's a public example, but there are many private Ponzi schemes where, it's not like our public company market. In the public company, you got to publish financial statements, you have audits, you have reviews, you have all these kinds of things. Different environment in the private market. And like I said, you shouldn't reward somebody for concealing a fraud for a long time.
Thank you. Thank you, Chair Clayton. Thank you, Madam Chair.
Thank you. Without objection, a letter from Better Markets will be entered into the record. I'd like to thank our distinguished witnesses for their testimony here today. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witnesses for their response. I ask our witnesses to please respond as promptly as you're able. Without objection, all members will have 5 legislative days with which to submit extraneous materials to the chair for inclusion in the record. And I thank you, and this hearing is adjourned.